Hey, good morning, everybody. Mark, when you say find history, um, do you mean, hey, Luciano, do you mean market replay? To go back and replay the market as though it were live? Or do you mean just to go find days in the past? I want to make sure I give you the right answer. And good morning, everybody. Jeffrey, Luciano, Miss Adriana, nice to see you. Zorro, Ron, Erla, we got everybody in here. I also see Hong, Veronica, nice to see you. Wayne's in here. Jonathan, nice to have you. T45. Good to see you guys. How to replay. At the end of the day, Wayne, I'll go through it. Hey, good morning, Shadow Picks. Nice to see you. I know you're waving and probably not asking to speak. Great. Post them in the room. And then as you post them in the room, Mark, I'll try to tie them into where we're at in the lessons. But let me have my first hour in the lessons to go over the rules. Let me talk about all those things that we're looking for on the charts. But I want every one of your questions, every one of them today. And then, Wayne, that's the link at the end of class, if you can be here. Because in order for me to do a full rundown to show you how to do market replay, I've got to disconnect from everything and close all my workspaces. And I'm totally willing to do that, but I need to do it at the end of class. There's a video right here. And what I did is I took my Ninja Trader on one screen and this video on the other screen, and I just went through and paused step by step. And it took me 2 or 3 times to get it to the point to where I never had to worry about it. But if you're here at the end of classroom, remind me, and I'll just run through it on mine to make sure that you're good. All right, guys, so let's get going today. 8:30 a.m., we had a little bit of news. You're welcome. Did anybody watch FOMC yesterday at 2 o'clock? That was crazy, wasn't it? If you've never seen it, it's a lot of fun, man. That market goes nuts. I was talking with my brother and realized what time it was. We were just talking about trade patterns for about an hour, and I was like, dude, FOMC's in 5 minutes. And it was crazy. It was so much fun. So I like to check news every morning. I want to make sure that I don't jump in front of that sort of emotional response. ForexFactory.com. I dropped the link in the room. I think I dropped the link in the room. Maybe I didn't. My links kind of got caught up. So let me put the link in the room for you. We've already made it through the 8:30 a.m. news. 10 a.m. we've got some medium impact. Existing home sales, that orange box. Medium impact can move the market. It can mess up your good times. So my trading plan says every morning when I'm sipping my first cup of coffee, go to the news site, check the news, and any place I see an orange or a red box, I choose not to trade 5 minutes before that. I wait for whatever reaction may happen, and then when the market gets back to a readable pace, then I'll go back and I'll start trading again. It's International Talk Like a Pirate Day. Arrgh. I like it. Pirate Steve, you're not even a real pirate. So guys, that's the first thing I do every day is I go check news. Build that habit because there's really 2 types of us in the world. There's those of us that have forgotten about news, traded into it, and lost money. And everybody's going to do it at least once. And then those of us that check the news because we lost money at some point and then came through. Big welcome to you guys that are new. I know that I have some new people in here. Some of you are on day 2 or 3, which is awesome. All the language is going to start to make sense to you. Those of you that are brand new, day 1, I'm gonna give you this picture real quick because I think what happens to a lot of people on day 1 is they believe that everything should click instantly, and it's just not the truth, guys. You're learning something brand new. And it's a little bit like drinking from a fire hose. It's going to feel like there's a lot coming at you. And maybe it is for day 1, and that's okay. So one of the things that I do to help circumvent that feeling is I encourage you and almost plead with you every day Keep it simple. Try not to overthink things. Nobody's ever had to learn how to build a watch in order to tell time. So the way this classroom is taught is the first hour every day, and I mean every day, talks about a high probability trend trade. It talks about a trade that typically wins 70 to 80% of the time. This is a trade that produces confidence through that memory of success. And this is a trade that's going to teach you to read your indicators, guys. And a high probability trade means that each indicator on every chart agrees for the trade. This is the best of the best. This is taking advantages and turning them into a trade. So what I encourage you guys in your first couple weeks with me is don't worry so much about the result of the trade. Let's focus on the process first. Let's get to the point to where we focus on one trade, because this trade is going to teach you to read your indicators. And that's exactly what we want. We're learning how to read our charts in the beginning. And when I say we, I mean you. There's no mouse in my pocket. But guys, chart reading, looking at your charts and talking to yourself in terms of the advantages that you see, this will literally be 90% of your day. 90% of your day will be spent reading charts, guys. And once again, I can tell you, I was up at 5 a.m. this morning. This classroom starts at 8 a.m. Central, my time. I've taken one trade today. That's it. I've had one instance where my rules were met. And patience is a big part of what we do. 90% of your day will be doing nothing. 10% of your day will be capitalizing on a few advantages and entering the market. And once you learn to read your indicators, once you get comfortable with what you're seeing, you're going to understand where the market is likely to continue. Initially, that will actually be your entry for the highest probability trend trade. You're going to understand where the market is likely to go, and you're going to see that in this classroom a lot, where people are taking profits right at these key Fibonacci areas. Wayne, I teach on the S&P and crude oil. I believe my trade this morning was on the S&P. And then, guys, you'll understand where the market is likely to stop. And these are what we call termination conditions. And this is really one of the biggest advantages that Nexgen gives you, is you'll be able to see key areas on your charts before the market ever reaches there. And you'll understand whether or not you should be taking trades or sitting on your hands based on those areas and a little bit of momentum. The high probability trend trade is 3 rules. That's it. 3 rules. Each rule gives you an advantage. The first 2 rules are your focus for the first week, guys. The first 2 rules are the most important rules, because rules 1 and 2 will give you the advantage of momentum, meaning a market that's likely to continue in the direction of the trend. And rule number 2 will make sure that none of those key areas, none of those likely to stop areas are in your way. And once you understand momentum and a clear path, you will begin to recognize patterns. You will begin to see opportunities outside of this first trade that I'm teaching you. But it's imperative that you can look at your charts and tell yourself truthfully whether or not these 2 are present. We're going to break this trade down today. We're going to do it individually. I'm not going to talk about winning, losing. I'm not going to talk about entries or exits. What I'm going to talk about is identifying 2 advantages first, and then I'll show you how to locate an entry through rule number 3 once the advantages are in place. But my focus are these first 2, guys. We're going to look for 3 rules on only 2 charts. My little laser printer right here, guys. That first bar on the large chart, that first bar on the large chart will define the direction of the market, which direction you should be trading. That first bar will define the momentum in the market through rule number 1, and that first bar will define whether or not you've reached an area that may stop the market or if you have room to your profit targets. 66% of your advantages come from the large chart. It's a slow chart. It's a very broad stroke of a brush. Once these rules are met, you'll turn your attention to a small chart. The small chart is a faster chart, and it gives an X-ray of this one bar. So inside of every one of these bars on the large chart, there's 20 to 30 bars on a small chart. There's a full retracement and a move in the direction. And we're going to use this refinement tool to pinpoint exactly where the market is most likely to continue. And this becomes your entry for the highest probability trend trade. By using a smaller, faster chart, you'll be able to reduce your risk. You'll be able to increase your profit potential. So it's only 2 charts, it's only 3 rules, but guys, write it down on a piece of paper. The large chart leads the way. We do that because the large chart is indicative of what the large crowd wants to have happen. The large chart are the men and women capable of producing trends and capable of establishing momentum. And these are the exact same people that are reacting to those areas and maybe making decisions that could take you out of a trade. So we let the large crowd lead the way, and we go with the flow, guys. We follow the crowd. The small chart is a smaller crowd, and they're still way bigger than we're ever going to be, guys. We have 0 power in the market. That's why we trade patterns. And these guys push against the large chart, and they create small retracements in the market that you see on the smaller, faster chart. We're going to pinpoint exactly where the small crowd is most likely to fail, and they fail typically 70 to 80% of the time. When the high probability trend trade rules are true, you're pinpointing their failure point, guys. That small chart is going to allow you to refine and enter where the market is most likely to continue. And then this is the most ignored page with new users. There is a step-by-step path to getting to where you want to be as soon as possible. This path has been proven for decades. This path has helped a lot of people get exactly where they want to be. And this path is also the most ignored path in trading history, guys, because we're all smart and we feel like we can just do this our way. I know because I've done it. But it's pretty simple. If you follow it, and you'll be amazed at how quickly the results come. Learn the trigger line and Fibonacci rules for when it's okay to trade. That's my job. The first hour of every day is designed to teach you these rules, to recognize them visually, to understand what the rules mean to you, and how to piece them together for a trade. You guys can simulate. You can practice. You can get in and literally pull the trigger and practice these rules and try these rules. And let's be honest, break these rules in the learning process. But the key is that you post your trades in the class. Every time you take a picture, every time you take a trade, post it in the room, and it opens you up for a private session. We're going to look at your chart. We're going to discuss the advantages. We're going to talk about entries or potential entries, or maybe, Hong, there wasn't an entry. And if you've misread your indicators, we'll adjust and fix that. If you have increased your risk, if you have reduced your profit potential, we'll go through and we'll identify each and every one of these, and we'll work on a plan together to fix it. So posting in the room is really one of the most important things you can do. And guys, you all have TechSmith Capture. It was downloaded on your computer when you downloaded the software. It's just a part of the process. We can go through and talk about this today if you need a little help with it. But this is the key. This is how we have conversations. I'm going to simplify a lot. I mean, I'm even going to tell you to ignore things, guys. And we're going to talk about a high probability trend trade, because this is the one that teaches you to read your indicators. This is the one that's going to open the doors for the next trades. But you have to understand what looks you will commit to. You've got to learn these looks so that they become easy. And what happens is the more comfortable you get with the look, it's almost like the slower the market moves. And that 2 to 3 minutes on an entry feels like 2 to 3 seconds in the beginning. But the more you commit to memory, the easier it becomes. And that's where the second half of your path comes in. Using the spreadsheet that Nexgen gives you, this spreadsheet is in your Nexgen Study Picks folder. I'm dropping it in the room right now because I like to share. Sharing is caring. The first tab on this sheet is nothing more than a trade journal, guys. That's all it is. It is a way for you to log your trades. And the key to getting the most out of this page isn't putting the pictures in there, but rather it's going back the next day and studying what you did, looking at what worked and what didn't work. Asking yourself what felt easy and what felt forced, and you'll see a very definite correlation between having these advantages and trades feeling easy and feeling relaxed. And when you knowingly fight these advantages, when you give up that advantage, you will feel like your trade is forced. You'll feel the nerves kick in, the butterflies. You'll find yourself moving stops and targets when you shouldn't be. So every morning, study what you did, accelerate the learning process, and then most importantly, guys, take advantage of this section. Every time I look at your chart, you're going to get feedback. Sometimes the feedback is, oh my gosh, this was perfect. Usually there's something that I see that maybe could be done a little bit better. Re-annotate your chart, write that feedback down, and every morning you're going to focus on these advantages that are creating opportunity, and you're going to focus on avoiding the patterns that are taking that opportunity. And one of the things that I'm really good at, if I can toot my own horn, is recognizing patterns in you, whether it's an early entry or a late entry or fighting a trend. Guys, 5 charts in that you post with me, I'm going to understand what your strengths and weaknesses are, and we're going to work together to embrace the strengths and fix any weaknesses that may be there. The second tab is the 101 tab, the rules for the high probability trend trade, guys. And all it is a visual of each rule broken down. Strong triggers up and down. If I click that link, it's a picture defining exactly what it looks like to have strength. I'm going to give you a sheet so that you can go through and fill this out with your own pictures, your own annotations, making sure that you commit these looks to memory. And then even more so, in the red, knowing what it looks like when the rules aren't met. Because it's this red section that's going to keep you patient, that's going to keep you from unnecessary losses. And then the favorite looks is where you'll build your own trading plan as you begin to fill it with pictures. And then finally, there's the client trades, guys. And this is where I just steal stuff from you. Turns out you guys are my favorite teacher, and every time you post a high probability trend trade, I may steal it and put it in here so other people can study it. I've got the entry sequences for shorts and longs, management, patterns that repeat themselves, and I always think new users, one of the best things you can do for yourself is go through and click on these and check them out and look what people are doing. If I click on this one, everything says down and the momentum is strong, and this young lady gets in right in an area of resistance inside of favorable large triggers and makes money all the way down. And I'm happy to say that this was actually my wife's picture when she sat through my classroom. So I just noticed that it was there. So go through the process, guys. Don't be shy. You're going to have to make yourself a little bit vulnerable. You're going to have to post in the room, and you're going to have to be okay with being wrong. But what you'll find is that every time you're wrong, you're 2 steps closer to being right, because you're identifying the things that are taking success from you. So every time you post in the room, I want you to talk about the 3 rules: momentum, path, and entry. And I want you to show me where you entered and where you exited. I want to see complete trades, guys. Everybody loves to show me entries, and that's great. That's a part of it. But management's the second piece of the puzzle. So let's make sure that you show me where you're getting out as well. Because I think more money is given away through poor management than poor entries with the students. And then using that spreadsheet, making sure that you're studying it. And then, guys, we're just going to get together and start learning rules. The first hour of class is dedicated to rules, guys. And it's the same hour every. So if you're brand new and you're like, man, I'm not keeping up, this is all new terminology for me, ask a question in the room, but understand that tomorrow it's going to be easier, and the next day it'll be easier, and then you'll really start piecing it together and it'll make it great. So rule number 1, large chart, big chart, slow chart, needs strong trigger lines. So the large chart's going to define the trend and the momentum. And you're going to see it just through the colors here. If the background on your large chart is green, that market's going up, and we're only looking for rules to be met for high probability trend trades long. If the background is red, the market's going down. We're only looking for rules to be met for high probability trend trade short. In order to have strong triggers in an uptrend, these are your trigger lines, the T3 trigger lines. There are small triggers, the solid lines. It's the 2 solid lines, they work together. These are your small triggers. 2 dashed lines, these are your large triggers. These are fast, these are slow. In order to have strong triggers, the colors have to match, guys. Your small triggers have to be green. Your large triggers have to be green if your background is green. And in order to have strength, there is a separation. The small triggers are up and above the large triggers. The large triggers must be wide or widening. They're angled in the direction of the trend. And guys, when I have this look, when this space is created, I want you to picture scissors that have opened. This is strong trigger lines. And when I have strong trigger lines, the odds are favorable for the market to continue up. You're going to hear it in class all day long. Did you have odds favorable momentum? Was there odds favorable momentum present? And that's where this comes from. And you'll see it annotated on charts, OFM, odds favorable momentum. In a downtrend, when the background is red, small triggers must be red, large triggers must be red. And then when the small break below the large are wide, angled in the direction of the trend. It's the space created between the two, the scissors are open, that lets me know that the odds are favorable for the market to continue down. Once again, odds favorable momentum, guys. These strong triggers can push a market in the direction of the trend. These strong triggers are what it takes typically to break those key Fibonacci areas, and these strong triggers will even cover the mistakes that we all tend to make as new users. Momentum is, in my opinion, the most important advantage because that's the one that carries the market. When you have strong triggers up, when you have strong triggers down, on the large chart, you're going to see these tails or these wicks. And you're actually going to be able to use that refinement chart to pinpoint exactly where these tails are most likely to happen, where they're likely to form, and that becomes your entry for the highest probability trend trade. So we're going to use these tails later to study the rules together to create the trade. When your scissors close, when the small triggers work their way inside of the large triggers, what you'll find is this is a weakness, a weakening of the trend, a slowing of the trend. And we call this weak triggers. I'm a big fan of language. You'll learn that about me over the next week or two. Strong, weak. Odds favorable to continue in the direction of the trend. And guys, anything can happen. Anything can happen. The market may go up. It may continue down. I don't know. I'll never know. But I know that the advantage is gone. So if you're a brand new user, what I really want you to do is I want you to keep it pretty simple. I want you to say to yourself, I need separation between the small and the large to identify momentum. And I need separation between the small and the large to identify momentum. And guys, this is your most current bar. Can you give me a Y if you see how on the S&P right now, I have odds favorable momentum to the upside. The smalls are above the large are wide, the space between, the scissors are open. Guys, this is the best of the best. This is a market that's likely to continue in the direction of the trend. I love it. Easiest lesson you're going to get all day. But that's only one rule. And it takes 3 advantages to put us into a trade. So once I have momentum, I'm going to look for that clear path. It is, Pete, but we're not there yet. I'm going to look to make sure that termination conditions are false, that there's no areas on the large chart that may stop the market, that may create an untradeable bounce or may create a reversal. Your large chart termination conditions, I'm going to drop this in the room, and we're also going to take a look at it. The easiest way to remember it, I think, and I could be wrong, is that a horizontal line on your large chart, a horizontal line, whether it's a divergence high, which is a pink line, a magenta line that prints off a pivot if there's a loss of momentum, or a divergence low, a cyan line, a light blue line that prints off of a pivot if there's a loss of momentum in the move. It could be either of those. It could be red Fibonacci resistance, and when the market is trending up, this may create a bounce. It might reverse the market. It can create a fight. Fibonacci support, another horizontal line. It's the blue line. And when the market is trending down, this could be a place where it stops. And then we also have these yellow 1-to-1s on your chart. And these are kind of fibs in the moment. And if the market is trending up and hits one, it may behave as resistance. And if the market is trending down, it may behave as support. And the wonderful thing is you don't have to know why these are formed or how they're formed or even who formed them. But horizontal lines on your large chart are where that large crowd are making decisions. When the large crowd is pushing up, everything is going, the momentum is strong. If they reach one of these lines, guys, they may decide to end their move. There may be a group of sellers from the large crowd waiting to enter their move and push against it, and they might just end up fighting for a while. And the great thing is you're going to see them long before you get there, guys. And we're going to use those T3 trigger lines to determine whether or not they're likely to stop the market. So when price reaches an area, and this is why I use the phrase, decisions are made at these lines. Price reaches the line, and that's what sets off the decision-making process. Your dynamic Renko bars are nothing more than a reflection of price. As it goes up and down, so do the bars. When your bars reach resistance, all you have to do is ask yourself, where are my trigger lines? If your trigger lines remain below resistance, and guys, every time they hit at first impact, they're probably going to be below, this is an area that may stop the market. This is an area where the buyers and sellers may fight, or there may be an untradeable bounce. No long trades into the area of resistance if the triggers are below. If price bars come down and reach Fibonacci support, where are my triggers? If my triggers remain above support, support may stop the market, may reverse the market, may create an untradeable bounce. And I'm going to give you a secret, guys. I don't tell this to everybody. You will never, ever know if it's going to stop the market. You will never know if it's going to bounce or break. But the recipe for saying no more trades into it is going to keep you out of an awful lot of losers. These lines create untradeable bounces more often than they do not. That's how rule number 2 came to be. So price reaches, if no triggers break that area, guys, no trades. And there was a huge run up in the morning. But if you scroll back on your large chart, there's a good one where we can just get a bunch of them in there. You can see how resistance stops the market cold, right back to support. And then these one-to-ones seem to have an impact, and then a divergence low, and then resistance and support, and almost to resistance and back to support. And over, these lines stop the market. And you know about them long before you get to them, guys. We knew about this line at 9 a.m. all the way back at 3:43 a.m. So as price came down to it, what a great target. That's where the market's likely to go. And then we just run through our process. Is it likely to stop the market? Could it create an untradeable bounce? Is everybody good with me so far? That was the S&P. What if we went to crude oil? Straight off of resistance and directly to support, guys. You've got to scroll back and you've got to start looking at these so that you can develop a little trust in the idea that these lines are capable of stopping the market. They're capable of ruining your good time. These lines break. Fibonacci areas break all the time. What's it look like when they break? Both the small and the large triggers must get to the other side of the line for it to be considered broken. So if your price bars come down and reach Fibonacci support, the triggers haven't broken, this is a termination condition, guys. It always will be at first impact. It may last for a second, it may last for an hour. Once the small triggers and the large triggers get south of support, support behaves as resistance. Very often they retest that resistance. That's going to help us with entries. But this is what it looks like to have a clear path. And that path remains clear until you hit the next line. And then the process starts over. So everything is coming up. Price bars reach Fibonacci support right here. All the triggers are well below. Absolutely no trades into this area. Small triggers, large triggers break above resistance. Resistance now behaves as support. The path is clear until you reach the next area. And guys, it really is that simple. It's either broken or it's not. That's your path for the first couple days. Keep it very, very simple. And what that's going to take you to, let me take a picture, is the second trade that we're going to talk about. When your small triggers, which are going to lead the way, smash through the area. And guys, I want you to embrace that word. When they smash, not peak or prairie dog. Everybody familiar with that term, the prairie dog, where it just pops its head right out? Maybe the triggers are right here. Guys, they smash through that area. And here's the key, is it has to be with odds favorable momentum. But the large triggers are lagging behind. Large triggers don't break. 50% of my triggers have made it. 50% have not. As long as there's odds favorable momentum, this line has the potential to break. It's not a guarantee, but it has the potential when 50% of my triggers break and 50% don't. This will be your second trade. This will be your second trade. I'm going to give you a plan how to take this trade, but in order to take it effectively, you have to know the difference between a termination and a clear path and understand that this is nothing more than potential. This will take you into what we call a medium probability trade. And that means that there's an issue on your chart. Every indicator doesn't agree. Your issue will be that the path isn't clear. So if we are embracing advantages, momentum is present, but the path isn't clear, it lets us know exactly which two advantages we should not give up. So if I don't have a clear path, I will insist on momentum and the smallest risk entry that I can find. So there are three options. Brand new users, learn to identify termination conditions. Learn to identify when you shouldn't trade into an area because the triggers haven't broken. Learn what it means to have the small and large above the area so that the path is clear until you reach the next area, and that will carry you to the potential to break look, the 50-50 look, guys. And those are your options. That's it. And it's kind of cool because I don't know why fibs come to be. I don't know what the calculation is to create divergence. Hell, how do these yellow dots happen? It doesn't matter. If I reach them, where are my triggers? That's all you have to do. And what you'll find is that once you understand this, you have to develop the patience piece. And there will be times when your path is not clear because the areas are stacked a little bit. Each of these areas has the potential to stop the market. So if I start to break through the first level of support and there's one right behind it, I have to sit on my hands. And if I finally start to break through this area and there's a divergence low behind it, I have to remain on my hands, guys. 90% of your day is doing nothing. 90% of your day is being patient. But the futures markets trade billions of dollars every day. Billions of dollars every day. It takes $400 a day to put you in a six-figure income. That's it. $400 a day. So we're going to get it with the path of least resistance, guys. You don't have to be in every move. Every tick is not your tick. Every tick is not your dollar. And you are going to find that the most successful traders aren't the traders that trade the most and capture every move, but rather they're the traders that sit on their hands and do nothing when the advantages aren't present. Patience is indeed a virtue. And rule number 2 is the one that requires the most of it, because now you can see where the driving forces of the market are likely to make decisions, where they're likely to change directions, where they're likely to create a fight. And rule number 2 can keep you out of consolidation and chop, and 90% of your day is going to be spent waiting for those advantages. 10% you'll be taking trades, guys. For you math guys, if you sit in front of your computer for 6 hours today, the likelihood is that you may be in trades for 36 minutes of that 6 hours. You don't have to be in every move. Is everybody with me so far? We're going to insist on the advantage of momentum through strong triggers. We are going to demand that the market has not reached a termination condition and that our path is clear. These two advantages on their own, guys, is enough to create a consistent, profitable plan. But once we have it, we're going to look for an entry. We're going to go to the small chart, the fast chart, the refinement chart, and we're going to pinpoint where we're going to enter the market. And if I go to that smaller, faster chart, and I see 3 divergences in the same price range, 3 of these blue lines from a low coming off of a pivot, 3 of these magenta lines from a high coming off of that pivot, guys, this is 3 losses of momentum on a small chart. These 3 divergences may happen within just 1 bar on the large chart. So your small chart will show change because it's a faster chart. 3 divergences may terminate the trend. 3 divergences may create an untradeable bounce. 3 divergences might reverse the market completely. So the only termination condition that we will ever accept on a small chart when I have momentum and when I have a clear path is 3 divergences. 3 divergences. Absolutely. Is it a termination condition, Morgan? Great question. Let me back up. Morgan's asking, hey Mark, on a strong top, does divergence count? And Morgan, anytime any one of these lines stop the market, divergence, fibs, 1-to-1s, and the triggers don't break through, and that market reverses from it, guys, this is a strong top. If price reaches Fibonacci support, none of the triggers break through, and it reverses the market, this is a strong bottom. And that strong bottom is the precursor to the highest probability trend trades that you can take. So yes, Morgan, divergence absolutely counts. 3 divergences on the small chart is the only thing that'll keep me out of a high probability trend trade. Or even cooler, if I enter on that pullback and I'm in a short trade, 3 divergences tells me, hey, it's time to take your profits, to get out of that trade. Let's wait for the next best setup. Every trade's not a home run. Every trade's not a winner. Your small chart's going to give you a lot of information to get you out if it needs to. But if there's not 3 divergences, we're going to define our entry. We are going to let the small crowd fight, guys. And rule number 3 is going to have you buying or selling a pullback at an area, at a fib, at a mid-band, at a yellow 1-to-1. And that area is going to be inside of triggers. And more specifically for the brand new user, that area is going to be inside what we call favorable large triggers. Favorable large triggers means that your large triggers, the smooth large triggers on your small chart, and your synthetic triggers, the stepped large triggers on your small chart. And Hong, you didn't have these on your chart. We need to reload a template. That just reminded me. When these 2 sets of large triggers overlap, when they're one on top of the other, 2 snakes riding piggyback, guys, this is the best of the best. This gives you the least amount of space to have an area, the least amount of risk, the highest level of accuracy. Because one of the gospel truths is that price loves to come back to large triggers. Price on a large chart will come back to the large triggers very often. If we go to a large chart, you can see that little spike back into the large triggers. You can see those spikes as it tries to return to the large triggers, and how price will even close the gap on large triggers coming off of areas. So we know that price returns to large triggers, and we've taken that correction point off of both the large and the small chart and put them on the small chart for entry, guys. So when we look at a small chart, the large triggers are where I expect price to return to on the small chart. Inside of those triggers, I have areas, mid bands, and a fib. These areas may create a bounce to continue with the trend. But I've also got the large chart large triggers, the synthetics, and price on the large chart may return to these triggers. And inside of them, I have a mid band, and this mid band may create a bounce. So we use both trigger lines in the areas within, and you're actually going to create a window where the market is most likely to continue. A window where the small crowd is most likely to fail, guys. And this window becomes your entry for the highest probability trend trades. So, large chart rules must be met. And guys, I've got a great picture of it from that driving force picture. When the large chart has odds favorable momentum, when the large chart hasn't reached an area, guys, you're going to be trading at the top of these bars. These tails happen after the fact, but I'm about to show you how to pinpoint exactly where this tail is most likely to form by using a smaller, faster chart. When everything says up, the path is clear, the momentum is strong, your small chart's going to look like this, and your fear of missing out is going to kick in full tilt. You're going to start to say to yourself, oh no, they're going without me, I'm not going to get paid, this is so sad, probably going to live under a bridge. And then the small crowd fights, guys. You get a reversal bar. This red bar after all the green bars says, hey, here comes the pullback. Here comes that little retracement. And the reversal bar is not your entry. The reversal bar is going to have you picking out your window of opportunity, the point where that small crowd is most likely to fail, where that large chart is most likely to continue. First, you're going to find your trigger lines, large and synthetic. Are they overlapping? Are they one on top of the other? If they are, that's outstanding. It gives you the smallest area to put a line. And once you identify your triggers, you're going to look for the lines inside. Fibs, mid-bands, yellow 1-to-1s. In this particular picture, I've got a mid-band and I've got yellow 1-to-1s. Either of these could stop the market. Either of these could create a bounce. So what you're going to do is you're going to create a window or a box. You can do it mentally. You could actually draw it on there, whatever makes you happy. Your window of opportunity, the point where the market is most likely to continue, extends from the highest point of support to the lowest point of support. And here's the key, guys, inside of those favorable large triggers. Any lines beyond the triggers are beyond where we expect price to go. Any lines below the triggers, on the wrong side of the triggers, these are not a part of the equation. We're not looking for entries here because at this point, price has already gone too far. It's gone through the areas, it's gone through the triggers, and this is no man's land. This is the wasteland. We never know where it's going to stop once we get to the back end. So blue box is your window. And then because of the momentum on the large chart, because of that clear path on the large chart, your entry is going to be right here, a tick or two above that highest point of support inside of favorable large triggers, guys. This is where we enter. And here's the reality, is I expect price, this yellow arrow, to come back to the triggers, and it could very potentially go all the way to the bottom of the triggers. I expect price to bounce, either from the highest point to continue or from the lowest point to continue. And this is why we create a window. But once price gets beyond the triggers, gets beyond the areas, I just don't know where it's going to stop. I don't want to be in this trade. And if I've entered that trade, I'm actually going to put a protective stop right there. And I'm going to say, my advantage is gone, no more. In a short trade, and one of the beautiful things about futures, guys, while everyone else is crying about their 401ks, we're just going to go short. With odds favorable momentum, with a clear path, I turn my attention to the smaller, faster chart. And I get a reversal bar. The reversal bar is not my entry. The reversal bar signals the beginning of the pullback. Once I get the reversal bar, the first thing I do is I look for my favorable large triggers, large and synthetic, one on top of the other, wide, angled in the direction of the trend. But this is not my entry. This is just where the price bars could return to. I'm going to look inside for fibs, mid-bands, or yellow 1-to-1s. And guys, I have one line inside of favorable large triggers. That one line represents the point where the small crowd is most likely to fail. That one line represents the point where this market is most likely to bounce and continue with the trend. I'm going to activate my limit order just below that line and hope the small crowd gets there. Hope I get my entry. Things that happen all the time. And let's take a picture again. Actually, before I do that, anything on the wrong side of the triggers, guys, anything beyond those trigger lines, beyond the areas inside of trigger lines, I don't want to be in this trade. My advantage is gone. This is where stop placements will happen. Because what we're doing is we're pinpointing exactly where the market is likely to continue, which means that we also know without question where the market should not go. Your initial stops will be placed where the market should not go, and this is generally 4 to 5 ticks above those trigger lines. And then with all the advantages, more often than not, you're likely to get a reversal bar in the direction of your trade, in the direction of the trend, in the direction of momentum, in the direction of the clear path. You'll reduce risk 2 ticks above that reversal bar for a short, or 2 ticks below that reversal bar for a long. This is kind of the first step in management, guys, and it's not uncommon to see you guys take perfect entries in trades that don't work and lose $30 or $40 as opposed to $200 to $300, hoping the market magically turns from the middle of nowhere. So your first 20 days with me is, and I say 20 days, and most people get it quicker than that. Your first 20 days is nothing more than defining the point where the market is most likely to continue. Studying these very basic rules so that you can have a great entry, because great entries create very manageable trades. Things that I see all the time, and I'm going to show you on this picture. And we're going to draw on it a little bit, guys. This picture does two things for us. First, it helps you with the study process. Anytime I circle a tail on the large chart, and it lines up with areas inside of favorable large triggers on the small chart, the rules are met. Guys, this is your overall look. This is what it looks like to take a high probability trend trade. These are the advantages on the large chart. This is the entry on the small chart. Things that I see very often. You guys will say, all right, I'm going to wait for the entry, and it doesn't hit your entry, and the market starts off in the direction of the trade. And I see you get in at the top of that bar. Or I see you worried that the move won't get you. And I see you getting in early, Andy. The only thing you've done by entering early, the only thing you've done by not waiting for the areas is you have increased your risk because your stop has to go down here. So you've just given yourself twice the risk that you should have on this trade. But even more importantly, guys, if you're getting in up here, you've shortened the distance to your profit target. So not only have you increased risk, but you've reduced your profit potential dramatically. And one of the things I see from you people that jump in early, you people, is you're not willing to keep acceptable risk on the trade. You're not willing to use risk where the market shouldn't go. And I see you get stopped out right at areas inside of favorable large triggers because you're not willing to put more than $100 on the trade. So your first 20 days, guys, is developing trust that this is your best chance of success, that this is your least amount of risk, that this is your highest profit potential. And what it also means is that sometimes it's not your trade. But this is why I push this so hard. Learn how to get in at the right spot. Keep it on simulator. Start building trust. Take these pictures, guys, and commit to this look. Commit to the advantages. And just give it 20 days. And what you'll find is that when you have momentum, when the path is clear, you can go back and circle those tails. When these areas have the potential to break, you can go back and circle these tails. And then you're literally going to open up a smaller, faster chart. And you're going to look, did that tail reach an area inside of favorable large triggers? If it did, it's a trade. If it's not, it's not. So, Hong, the reason I say that the stop has to be lower, because your initial stop is where the market shouldn't go, on the other side of the triggers. That doesn't change, ever. That doesn't change because you get in higher or because you get in lower. This is where the market shouldn't go. Does that make sense? If this is going to be a successful trade, it shouldn't push past all this stuff. It shouldn't get to the wrong side of the triggers. If it does, you don't want to be in that trade anymore. This is where your stop goes. And it doesn't matter where you enter. If I enter right here, my stop belongs here. If I enter on the way down, my stop belongs here. The only time that may change is if you enter here after the reversal bar. Well, then you can get in with a little reduced risk. Andy, the lesson you learned yesterday paid well today. Great entries today, Andy? That's what I want to hear. Did you enter at the areas? Yeah. So guys, what Andy just told you is that this classroom works. If you post in the room and I find a way for you to do it better, if you post in the room and I see you putting unnecessary risk on a trade, if you post in the room and it can be more efficient, we'll talk about it. Andy took yesterday's lessons, and at 9:47 a.m. his goals are met. 9:47 a.m. his goals are met on the day. Andy, outstanding. It's stuff like that excites me about teaching. But you've got to learn the advantages so that you can pinpoint, guys. The easiest way to do that, in order to get to where you want to be, you've got to be able to recognize these advantages quickly. In the beginning, you're going to talk yourself through things. That's okay. You're brand new. Give yourself some grace. But in order to really get to where you want to be, and I stand behind this 1,000%, is pictures. Taking pictures is more effective than taking trades in the beginning. Taking pictures of strong triggers, of weak triggers, of a clear path of termination conditions. Taking pictures of high probability trend trade entries and burning them into your memory so that when you're looking at a live market, you know exactly what you're looking for, guys. This Chart Reading 101 page is designed to help you with that. This Chart Reading 101 page here is designed to get it to where you can commit the looks to memory, and so that you also know what it looks like when you shouldn't be trading into an area. So go take 25 pictures of each, stretch it out over a week, and I promise you by the end of that week, by the end of 25 pictures, you will be an absolute rock star. You're not taking trades, you're not trying to make money, you're not showing off how smart you are, all you're doing is committing looks to memory. So in order to really solidify the lesson, is you have to annotate that chart. You have to write down why it's strong triggers, what is the look, what does it mean to you, what rule does it pertain to. You're burning it into your brains. And then eventually you'll piece these individual parts together to create a trade. This is going to help with it as well. Is the market coming from a strong top or bottom? Is the market coming from a termination condition that reversed the market? When price reaches these yellow 1-to-1s and the triggers don't break, that's a termination condition. When it reverses the market, that's a strong bottom. The market reverses from here, but it's not a termination condition, not a strong bottom. It reverses below the fib, not a strong top, guys. This is the one that sets you up for the highest probability trend trade you can take. But it's not mandatory. As long as those three rules are met, odds favorable momentum. What it looks like, the opposite. Clear path. What a clear path looks like. What it means to not have it, and then a reminder of that potential. And then guys, both of those pictures that I teach class with to show you how to identify and where to put your entry for the highest probability trend trade you can take. This is coming to you as well. This is how you're going to police yourself as you take those pictures. The second page is a checklist, guys. This is what I want you to print out. Page 2, put it on your desktop, grab your biggest crayon in the brightest color, and make sure you can mark yes to these. If you can mark yes to all 4 of these, I've never had anybody do worse than 70%, guys. I've had people fund accounts inside of their first 30 days with Nexgen. Marking yes to each one puts you in the highest probability trend trade that you can take. Marking yes to these 3 still puts you in a huge advantage. I've never had anyone do worse than 70%. But guys, the high probability trend trade doesn't happen all day. Most of your trades will be that medium probability, those 50-50 trades. But right now we're creating recognition of advantages and we're learning how to pinpoint entries. So print this out, police yourself. If you're doing market replay, you have the ability to hit pause before a trade and make sure that your rules are met. And market replay will show you the potential of the methodology and how much money you could have actually made that day if you just followed a plan. And that takes us to the next thing. You're going to need a plan, guys. You're going to build your own. I'm going to tell you that right now. My goal for everyone in this room is that you build a plan that's solid, that you no longer need me, and that you fire me. And you don't come into this room anymore because you're finding success. Until you get there, don't you dare ditch this room. Hang out. Let me help. This is the KISS plan, the Keep It Simple Sunshine plan. You guys know what the other S stands for. This is a stepping stone in your learning journey. This is a stepping stone. The high probability trend trade is not your only trade, ladies and gentlemen. It is your first trade. Man, Morgan, you can always come hang out. And guys, you don't have to leave this room. You can stay in this room forever. But remember that it is an educational room. So when you're out there being a full-blown rock star and you post in my room, make sure you talk about momentum, clear path, and entries, because we're learning here. Guys, the high probability trend trade in this plan is designed to optimize your chances of success with that high probability trend trade. Optimize your chances of success. This is the best of the best way to take this trade. Through simulation, study, class feedback, and continuous practice, you'll craft a plan, and it's going to revolve around your ability reading the indicators. Guys, you can have high probability trend trade rules met on the large chart and find 20 different ways to enter it on the small chart. That's going to come in time. But in the beginning, the easiest thing to do is never fight the large chart, guys. Large chart is the large crowd. The large crowd sets the tone, sets the direction, establishes the momentum, reacts to areas. Don't fight the large chart, and you will be 70% better than 90% of the world. Guys, how to commit financial suicide. How to commit financial suicide. Trade against strong triggers. Trade in determination conditions. Surefire way. So Hong, what Andy incorporated yesterday, it's easier for me to say it than type it, and I'm sure Andy doesn't mind me saying it. If you remember Andy's charts yesterday, let me open up a picture here real quick. The one thing that we saw on every one of Andy's charts yesterday is he entered the market right about here. He didn't wait for the pullback to the area inside of favorable large triggers. Instead, he was jumping in, hoping the market didn't go without him. And what happened more than once yesterday, Hong, is he could have made his $100 and then maybe the market changed direction. So he entered himself out of profits multiple times, not waiting for the area inside. Today he fixed that mistake. He got in where the market was most likely to continue and hit his goals in a couple hours. So what Andy did, and Andy's been with me for a while and he knows these rules, is he just needed to backtrack a little bit. He needed to be reminded that his highest chance of success comes from areas inside of favorable large triggers. And it's a pattern that repeats itself every day. And guys, this is a natural and normal part of the learning process. You will follow your checklist. You will be a stickler for the rules. And then you will start to feel too smart. And you'll begin to abandon the things that created success. This KISS plan is designed to reel you back in. So you're going to define your entry. You're going to embrace the advantages. You're going to get in where the market is most likely to continue. And guys, your management plan is based on your ability to locate this entry. The management for the high probability trend trade is 100% dependent on you getting into the market where the market is most likely to continue. Because the other side of that equation is understanding where the market shouldn't go. And your entry defines that as well. The market shouldn't go beyond the trigger lines. It shouldn't go beyond the areas in the trigger lines that get you in. So is everybody good with that? We're going to enter at the lowest point of resistance inside of favorable large triggers. Your initial stop will go beyond those trigger lines. 4 to 5 ticks. And if they push past everything, you're going to lose a trade. Anything that wins 70 to 80% of the time has to lose 20 to 30% of the time. But if you had odds favorable momentum, if you had no terminations, if you get in at areas inside of favorable large triggers, guys, more often than not, that market's going to give you a reversal bar in the direction of your trade. The KISS plan management says that if you don't get stopped out on the other side of the triggers and you get a reversal bar, you're going to move your stop 2 ticks above that reversal bar for a short. You're going to move your stop 2 ticks below that reversal bar for a long. And at this point, here's the part that's going to get you, there's nothing to do. You're either going to get stopped out or it's going to hit your first target. You're not in control of that. You'll never be in control of that. The only thing you're in control of is whether or not your rules were met, whether or not you had that advantage going into the trade. And guys, if you don't get stopped out, and it goes to your first target, that's $100 in your account. It's only $100 from entry. And on crude oil, very often you're going to hit that first target, and that's going to be your reversal bar. It's kind of cool how that happens. $100 creating confidence. $100 drying the sweaty palms. $100 shooing away those butterflies from your stomach, guys. This feels good. And there's a lot of people going, but Mark, I can't get rich on $100. Nobody in this room walks over $100 on the sidewalk. Remember that. We're learning how to get paid. And once you get paid the $100, you're going to move your stop to break even. Not the best stop, not the smartest stop, not the highest probability stop, guys, but you're going to create a management plan based on your ability reading the indicators once you have some reps. But what that first stop does for you is it begins to develop trust, guys. It sets you up to believe in your heart that where'd it go? That odds favorable momentum, that a clear path is why you're in this trade in the first place, that there is a large chart absolutely screaming in the direction of the trade. And that break even stop, guys, makes it easier to hold for the second target. The second target in the KISS plan is $200 away from your entry. If you take a high probability trend trade and it goes from start to finish, that's a $300 trade. And it doesn't matter what happens next. You just made $300, guys. The KISS plan is designed to teach you how to get paid consistently, how to get paid conservatively, and then through simulation, study, class feedback, continuous practice, you'll create your own plan. You'll work your way into the second trade. The second trade is that 50-50 trade. That medium probability trade that shares advantages with the high probability. Is in order to take that potential to break, you need to come from a strong top or bottom. So you have to learn this lesson from the high probability trend trade. You have to understand odds favorable momentum, the lesson from the high probability trend trade. You need to be able to recognize divergence. Divergence is the biggest killer of the 50-50 trade. And you're going to understand that because you know that 3 of them is a termination condition for the high probability trend trade. For this medium probability trade, 1 of them is a no trade scenario. And then you've got to be able to define the areas inside of favorable large triggers. On the 50-50 plan, it reminds you that divergence means no trade. And then when you get to management, it reminds you again that if divergence prints, you have to exit that trade. So they're 2 very different trades with very similar rules. Learn the first one, it'll set you up for success on the second one. And to that note of $100 isn't a lot of money, guys. $100 a day, if that is the absolute best that you could ever do in your life, is $25,000 a year. One of the great things about all these new prop firms is they create trade copiers, guys. And if you can find a way to never miss $100 a day, you can mirror that on 10 accounts and turn it into $1,000 a day, which is like $250,000. Or you can mirror it on 20 accounts. And you could turn that $100 a day into $500,000 a year. That $300 a day is $75,000. $75,000 from one successful high probability trend trade a day. Guys, this is outstanding. You don't have to make all the money to make money. You have to make consistent money. You have to make the highest probability money. And when you start trading live, guys, you have to know why you will enter a trade. And you also have to know why you will exit a trade. You have to have a plan for entry and exit. And commit to having the rules met. If your rules aren't met, it's not your money. If the rules aren't met, it's not your trade. If the rules aren't met, your advantages aren't there, guys. Rules are patterns that have been proven to win more than they lose. Otherwise, they should never be in your rules. The more consistent in action you become, the more focused you are on the process, the more likely the profits are to come. Guys, process yields results. And the rules are going to help remove emotion. And you will get to a point, I can tell you this from experience, you will get to a point. Where are my pictures? You that when you set that limit order to enter that highest probability trend trade, if you get your entry and your stops in the right place, you won't care if the small crowd wins. You won't care if you get stopped out, because you know that you're trading a pattern that wins more than it loses, guys. So commit to the rules, learn the rules, keep it simple, focus on entries, let your management be as mechanical as your entries until you can read your charts. So if you're in a high probability trend trade, you know exactly what it's going to take to get you in. You have a plan. And you know exactly what it's going to take to get you out initially. You have a plan. Commit to learning how to follow rules in the beginning, guys. That's what's going to bring you success. And as you grow with the software, you will grow. You will absolutely grow. And your plan will grow with you. So in the room right now, I just dropped in there. I gave you Chart Reading 101 so that you can break down the looks individually and learn them. I gave you the KISS plan that gives you the way to optimize your chances of success with both the high probability trend trade as well as the 50-50 trade. I've given you my PowerPoint in PDF form so that you have every picture that I use to teach this classroom. I gave you the Chart Reading 101. I think I already said that. I gave you the high probability trend trade checklist, those pictures that you can make sure you understand what it looks like as you learn, and also that checklist to put on your desktop. I gave you that daily goals PDF, and remind yourself that your goal is to get paid, and that exit conditions PDF, the one that reminds you that you need to know why you're going to get in and why you're going to get out, and those rules change for every trade. So guys, you now have, and this is pretty cool, you now have everything that you need to be successful with this software. You have the rules, you have what they look like, what they mean to you, you have how to study them, both individually and as a trade. You have a concrete plan to enter and exit. The only thing that you don't have at this point is experience. The only thing that you don't have is the repetition to become comfortable with it. And this is, guys, one of my wife's favorite words is grace. Give yourself a little bit of grace. You're brand new. Don't feel like you have to know it all in a day. And I'm going to share this, and then we're going to take a break because I think breaks are important, guys. The reason I teach the way I teach, I'll drop this in the room too in case you want it. We talk about 3 rules on 2 charts. Simplicity is our battle cry for the first 20 days, guys. And once you recognize momentum, you can see a market that's likely to continue in the direction of the trend. And once you recognize a clear path, you can see that there's absolutely nothing in the way with that momentum, guys. And you have to picture a semi-truck doing 100 miles an hour down the highway. It is hard to stop. And these 2 concepts alone are enough to create a trading plan. But until you can read your indicators, we give you that high probability trend trade. And it's not your only trade, it's your first trade. It's giving you confidence, it's teaching you rules, you're identifying advantages, you're learning that best of the best entry. So the first hour of class is designed to that trade. It revolves around that trade. It's the same hour every day because I firmly believe that repetition creates recognition. The next 2 hours of class are yours. The next 2 hours of class are designed to look at your charts, to look at your trades, to read your read on the indicators, which is why it is so stinking important that you tell me what you see, where you got in, or if you didn't take a trade, that you do exactly what Hong did earlier. And let me click on Hong's chart. This is how you're going to get to where you want to be. And Hong, we will come back and look at it, I promise. And we'll do it as a class. Brand new student. Oh, I see the odds favorable momentum. And I see that there's nothing in the way. Where's my entry? Working on rule number 3. And Hong, the lesson on this one, unfortunately, is there isn't a high probability trend trade entry here. There wasn't a pullback to areas inside of favorable large triggers. So as a brand new user looking for that high probability trend trade, you just have to accept that maybe that wasn't your money. Not yet. There's a trade that everybody's taken in this room, and Ron just dropped one in there, that'll have you capitalizing on this look and taking little snippets when there's this much momentum and a clear path. So that's kind of going to be your progression. But the one thing that I notice, Hong, is you don't have synthetic triggers on your small chart. Did you notice that? Most people don't. That's why posting in the room is important too. If there's something missing on your chart, I'm probably going to see it. So what I need you to do, are you with me? Let me make sure before I give this lesson. Otherwise, I'm just talking to an empty room on this one. So what I want you to do for me real quick, let me go to my charts, is right click on that chart and go to templates down here. And I want you to load the Nexgen 5-1 Renko bar chart. And this will put those synthetic triggers on your chart. I'm not sure which template's working in there right now, but this will give you both large and synthetic so that you can have both, so that you can pinpoint entries. And one of the things that's important to get those synthetics on there, once again, right click and go to data series and make sure that that tick replay is checked. And that's what brings things over from the other charts. That's what brings those large triggers over from the large chart. So guys, if your chart ever doesn't look right and you need help, post a picture. I'll help you fix it. If I can't help you fix it, Jason is the best of the best, and he'll have you fixed in a matter of minutes. I'm not always that fast. So guys, look at that termination and look at the reaction. Isn't that outstanding? Each and every one of you knew about that line, and even with odds favorable momentum, not one of you took that short trade from the mid band, I hope. No reason to give that money away. This is what we call avoidable losses. And the difference between successful traders and unsuccessful traders is very often the ability to do nothing when there's nothing to do. So we're going to come back in about 5 minutes. I am going to ask you guys, please, when you post a chart, talk about those 3 advantages. I'm going to click on every chart. We're going to discuss them. If you have a question, post it in the room. Remember that your participation is what's going to get you to where you want to be. If you're sitting quietly in the shadows and you're confused and you're not willing to ask a question, you're probably going to remain confused. And just a heads up, guys, I will say things that you don't want to hear. I will tell you that your great trades were completely void of advantages and you just got lucky. Brace yourself. I'm the warm fuzzy Novak, but I'm going to give you honesty, start to finish. I'll see you guys in 5 minutes. Go stretch your legs, and then we'll get into the second half of class. All right, guys, let's get back to it. And Narayan, I hope I said that correctly. It's okay to be confused on day one. It really is, and it's totally normal. And I've been day one myself. I started with the software just like you did at one point, and it really does. It gets easier. And if I can ask a couple people, Hong and Veronica, is day 3? Does it feel like it's starting to click a little bit by day 3? Who else is relatively new here? So right now we're looking at a large chart and we're looking at a small chart. And it almost seems too simple, right? This is the big chart. This is a slow chart. This is your small chart. This is where entries happen. And we use this 2-chart process because what it does is it gives us a great look. The large chart, let me open this up. The large chart is the chart that we use because it's a slower chart and it's going to define the direction of the market. If the background is red, the market's going down. If the background is green, the market's going up. It'll also define the momentum in the market through rule number 1, using strong trigger lines to let us know when a market is likely to continue in the direction of the trend. And this large chart will also define whether or not these lines are in the rear view mirror and no longer important. Can you guys hear me? Give me a Y. Nope, I was off. My bad. So, my apologies. A lot of mouse moving, nothing being said. Are we good now? Can you guys hear me? Okay, awesome. So let me go back and repeat. So this large chart, and I love that you guys are jumping in the room and helping it too. And Pete, thanks for the head up on the audio. So the large chart and a small chart. And this is the easiest way to think about it. Big chart, little chart. And we use these 2 charts. Your large chart is slower. It's a larger, slower chart. And this is kind of the overall opinion of the market. So we allow the large chart to define the direction of the market. If the background is green, we're going to say the market is going up, and we're only going to look for rules to be met for trades going up with it. The large chart will define the momentum in the market, making sure that we have that advantage in place. This is rule number 1. And then the termination conditions are these lines that may stop the market. So the large chart's also going to define any problem areas. And one thing I asked when I thought I was actually talking to you guys, and this is, so Hong and Veronica, and who else has been with me like 3 or 4 days? And you guys that have gone through the process as well. Hong, is it easier to understand where we're at on day 3 than it was on day 1? And Veronica, same question. Because day 1's confusing. I know it's confusing. There's a lot of new terminology. It's all built for you. I'm sorry, I'm not completely sure how to say it. It's all built for you. So all you have to do is when you open up NinjaTrader, is go to workspaces, and Nexgen has already built you the workspaces, and they've already built the correct templates, and they even have, when you open them up, they even have stops and targets for you. And one of the great things is we don't force you to make decisions on chart size or the way the indicators need to be. The only job that you're going to have, and this is kind of cool, is to just learn this one pattern that's been proven to win more than it loses. How's that for low maintenance? So is your software open right now? Are you looking at it on your chart? Or on your screen? On your end, not my end. Oh, no worries. So when you're choosing a workspace, I'm going to teach class on crude oil and S&P because they're very smooth flowing. The pattern set up, the rules are easy to teach on this chart, on these charts. So I would say pick either crude oil or the S&P, or even both if you want. Take a look at them, see how they move. The NASDAQ is like the S&P. If the S&P was on an all-night bender and smoking meth. It's like 10 times faster, and for new people, it's virtually untradeable. It really is. Veronica, when you closed out your crude oil workspace, did you use these red X's up here to get rid of those charts? No? So when you hit crude oil, nothing comes up at all? You hit close. So you went through and you said, close. Do I want to save it? Yes. But it's not showing up this morning? That's odd and not normal. So there's a couple things that you can do. There is are you computer savvy? That would be the first thing that I ask. Nope, then that's okay. Okay, the bars are frozen, you said. There we go. So it does open up, but the bars aren't moving. Haha. Do you have the green dot? In Hong, you find you have to reload historical data. ES works fine. So there's a glitch somewhere. And one of the things that you guys will realize is that I'm pretty good with simple fixes, but I'm not the most tech savvy guy in the world. So Veronica, I just put a link to tech support. Nope, not yet, Jeffrey Dean. Click on that one. Jason is the best tech guy in the business. And he will literally get on your computer and fix whatever's broken, probably inside of 3 minutes, and get you back in the game. And I know that's a little inconvenient, and I apologize for that. But that's where I go. Jason's my tech guy too, if I can't figure something out. So, Narayan, what we're going to do is when you open up and look at it, we're going to start just practicing rules on each chart. And I believe Hong came in and kind of verified that after a couple days, it really does all start to click. The verbiage makes sense. The functionality really gets there. And one of the things you guys can do as you begin to get familiar with NinjaTrader is if you go to the software guide, if you're brand new to NinjaTrader, like everything and anything that you could ever need to function this platform, we've gone through and we've done all of it to give you a little something to do. But always do what you're doing. Ask questions in class, and I'll do my best to answer all of them. And right now, we're going to go to some of the questions that were asked. And I'm going to click on some of the charts that were posted. Guys, if I go too fast reading these charts, please feel free to tell me to slow down. And Andy, I'm going to click on all of yours. Andy was in here yesterday afternoon, keeping me busy. He says, I'm going to give Mark lots to talk about first thing in the morning. And I love that, guys. The more often you post in this room, the better it is. So Andy says, check it out. It's a strong top. This is a termination that reverses the market. And the reversal is where the large triggers go from green to red. And then once it's a strong top, Andy says, check this out. My small triggers smashed through, but my large triggers didn't make it. This is one of those 50-50 looks, one of those potential to break looks. And Andy says, I'm going to wait for a pullback. And here's my large triggers, and price might come to these triggers, but there's no lines inside of it. And here's my synthetic triggers, and price could come to here. And look, there's some of those cool lines right inside. And that becomes his entry, his initial stop, 4 to 5 ticks above those trigger lines. And sure enough, the market bounces and continues down. And I'm pretty sure it's safe to say that had you taken this trade, you would have gotten paid. Great trade, Andy. Nice job. And rule number 2 will keep you out of trades. Full hour of consolidation. 1 hour of binging and banging in between areas, guys. Rule number 2 keeps you from giving away your money when the advantages aren't present. And then Andy, odds favorable momentum, clear path. And you said divergence and midband, but it's on the wrong side of the triggers. Andy, this is very much the right side of the triggers. But if you enter, because we expect price to make it to the triggers. Here it just didn't make it. And this is where you got to say, man, it might not be my money. There was so much momentum, the small crowd couldn't get you back to an entry. And that's okay because there's so many opportunities in the market. No sweat. It just didn't happen. Just wasn't your money. And then you missed this one on the 50-50. Perfect pullback to an area inside of triggers. And then odds favorable, clear path. And I love this one. Panicked and jumped in. And then got stopped out on its way back to the perfect entry. And guys, this is one of the greatest lessons. Wouldn't Andy enter and just sit through the small down? So Hong, everybody has different pain tolerances. I guess is the best way to say it. For me personally, because of the rules that I teach, because of the rules that I follow, I'm not willing to get in at 29 and have a stop at 05. I'm not willing to put $240 of risk on a trade per contract. That's just me personally. That doesn't fit my pain tolerances. That's an awful lot of risk. Does that make sense? And do you notice how the line isn't inside of the triggers? So we're kind of piecing it all together. And this is one of those times. So, and he wrote over it. Andy made it hard for us to see, but that's okay. So the way I calculate that is if I enter right here, and that's what you're saying, right? Get in at the midband because you've already done a great job recognizing the areas. That midband's at 29. 5 ticks below my trigger lines is somewhere around 05. So this giant space between my entry and where stop has to go, where the market shouldn't go, is 24 ticks. And on crude oil, it's $10 a tick, which means that that is $240 risk. Does that make sense? But here's the other side of that. If Andy said, dang it, it didn't make it, but if I get a reversal bar in the direction of the trend, in the direction of the momentum, when everything says up, once you get a reversal bar, the rules say, hey, guess what? You can put a stop 2 ticks below it, and suddenly he has 12 ticks of risk and not 240, and everything's going the direction. So when I said that you guys will get to a point to where once you learn this look, you may find 50 different ways to enter a market. But the stop placement never changes if it's pre-reversal bar. Does that make sense, everybody? So sometimes if it isn't perfect, lines aren't inside, but everything says it's likely to go up, people will wait for this reversal bar in the direction of the trend. It doesn't guarantee a winner, but what it does is it allows you to put your stop behind it. So if it does come back to those triggers, you have less risk on the trade. And yeah, Andy, $480 risk, it's just not there, right? Does that make sense? It's a byproduct of the calculation that told me that there was a loss of momentum. So every time you see one of these negative numbers print and that divergence line print, this is just, it's a byproduct of the calculation. There's no way to keep it off of your chart, unfortunately. But it has zero bearing on the strength of divergence or the likelihood of it to break or hold or anything like that. Just ignore. It's a byproduct. It's like the receipt for buying something. It lets you know that divergence is true, that there was in fact a loss of momentum. Perfect. And then everything says down. And Andy, this is one of those times, right? And Hong, do you see how there's no areas really inside of the triggers, but rather that mid-band is beyond the triggers? These one-to-ones are at the top of the triggers. This is one of those times that once you get past those triggers, it may go. It may come all the way up to this mid-band. It may go to the next Fibonacci areas. It may never stop at all. This is another one of those times when the large chart says we're most likely to go down, where you may wait for that confirmation bar. Say, hey, my entry isn't perfect. Let me make it go in the direction of the trade before I enter. My risk will be established, and I have room to make it to the next target. So, Andy, mid-band held, absolutely, but there was no way of knowing if it would or not. And that's what I want you guys to get out of this. Once you're on the wrong side of those triggers, you're hoping areas hold. That's where the confirmation bar may pay dividends for you if you're still in the mood to take the trade. Good stuff. And then FOMC, look at how much that market moved. Isn't that crazy? That is fast. That's a matter of seconds. And that's an $800 move. That's why we don't trade into FOMC. But what's kind of cool is even in the heat of the moment, guys, look at that. The fib held. 20 seconds worth of movement and the fib held. Pretty outstanding. All right, Andy, good stuff, man. Where do you go to see historical and trade and see profit? On NinjaTrader? So trades that you've taken? Let me make sure that I'm getting the question right. So one thing during the day, every trade that I take, well, if you didn't take any trades, there won't be a paper trail. And you have the burden of proof, right? So what you could do, Hong, is you could go back and you could take these trades. You could say my rules were met. This was my entry. Here was my exit at a fib. This is how much I made, right? I don't paper trade and show you results because you never know. I might be full of beans. I could make that up, couldn't I? I could say, hey, guess what, Hong? I made $1 million yesterday. Isn't that outstanding? And you don't know how I made it. You don't know if it has anything to do with the software. It's just a number. But if you go back and study these entries, if you go back and see how many times momentum pushes to the target, if you go back and do all this, well, then you'll have an idea. And if I go back and click on somebody's chart, all right, let me find someone here. Ollie, don't you let me down. Ollie traded into the gap theory. You traded into the gap theory. So that wasn't the best example. Ollie. Gap theory, split triggers. That's it. Yes, Hong, I want you to do fake trades in Sim. So watch this. I'm in Simulator right now. Hell, I can just jump into the market. There's my fake trade. We'll see if momentum beats terminations, right? And then what you do, Hong, is you go back and you start snapping pictures of what you're doing and you start pointing out advantages and disadvantages. And if you showed me this picture, what we would do is we would say, hey, let's talk about, no, Pete, I'm messing with your OCD. I don't teach anybody that just to mess with you. We would say, Hong, let's talk about termination conditions. Price reached these areas and the triggers didn't break yet. And I'd say, great job recognizing that momentum. And I would say, I want you to see how you didn't wait for a pullback. You just kind of jumped in right into trouble. So Hong, what we're going to do is we're going to look for something a little more like this, when there's the potential to break and actually waiting for the pullback. And even though the area is just a little bit above, we know because of where the market shouldn't go that if I enter at the mid-band, there's my established risk already. So yeah, absolutely. I want you to crank that simulator up, and do everything. Make every mistake. Just take pictures and show me what you're doing. Does that make sense? But you can fake trade all day long in Sim. They give you $100,000 to start with. And if you burn through all 100,000, that's okay. I'll teach you how to reset it. And then for Pete here, one of the things that helps me when you show me pictures, guys, is making sure that I can see where you entered and where you exited. So if you right click on your chart and go to data series, this is good for the education. It's good for going back and seeing where you're entering too. Make sure that it says text and marker down here on plot executions. Because every time you enter, when that's on there, if I go short, it shows me exactly where I entered short. When I went long, it showed me exactly the price and how many contracts. And then we can use this. Absolutely, you can go back historically, Hong. So you can do it real time during the day when the market's open. I love these questions. And then you can use market replay. Market replay will let you go back and replay any day from start to finish. And market replay will also give you the opportunity to pause the market. When you think you have a trade setting up, you'll be able to pause the market. So my wife is on market replay right now, learning how to trade. And before she takes a trade, when she thinks she has a setup, she goes directly to her checklists and verifies that the rules are actually met. So this is a great way to test the methodology as well. This is a great way to work on patterns. This is a great way to test new management plans even. And Wayne asked me earlier at the beginning of class, so at the end of class today, I'll shut down my NinjaTrader and I'll go through the whole process of loading up market replay so that we can do it live in front of you. The way I learned it was this video. And I think it's like a 4-minute video. And I would have this video on one screen and NinjaTrader on the other screen. And I just went back and forth until I got it down. But we'll do it at the end of class. I've got it written on a piece of paper right in front of me to make sure that I don't forget it. So yeah, you can go back. Hong, if you were bored tonight, you could replay 2 or 3 days. And it'll allow you to fast forward. It'll allow you to pause. And it trades exactly as though the market were live. And guys, did you see the indecision right at the termination condition? No, there's no silly questions, Hong. I've been on day one. I've been right where you are. One of the greatest lessons I can give you guys, look at the large chart. It's easy to convince yourself that it's going up. Look at the small chart. Look at the dance right around the fib. This is why we let the large chart lead the way. And you're right, Andy. Hong, you also have 10 days worth of data that you can just scroll back. And just take pictures, right? Here's momentum. Here's a termination. That's what it looks like when an area breaks. And you can start to piece these together without actually trading. But we'll go through market replay this afternoon at the end of class and make sure everybody in this room is cool with it. Because I think that's one of the best, right? In 30 days, you can get 30 days experience. But if you use market replay in 30 days, you could get 3 to 6 months experience. You can go back and replay all sorts of markets. All right, next picture. Keep the questions coming. Next picture. Strong top. It's a termination. It reverses the market. It provided odds favorable momentum. And it's a 50-50 trade. This area has the potential to break. Guys, that is the large chart read. So, Narayan, and I'm probably going to say that different every time, and I apologize. Everything begins with momentum. Smalls below the large, larger wide. Here on the large chart, Morgan says, look, I have odds favorable momentum. I have a market that is likely to push in the direction of the trend. And then he goes to rule number 2, and he identifies whether he has a clear path or not. And he says, my small triggers have smashed through the area, but my large triggers Have not. Pete, the mid-band is a termination condition when the large triggers are a full bar away. Therefore, a termination with no triggers through that reverses the market is a strong top. Boom. Ha ha, mic drop. But I love that you did that, because actually even the one-to-ones were close but not quite. But you got the mid-band disclaimer on there. Good stuff, man. I love it. So potential to break and all the momentum in the world. And Morgan says to himself, because he's an amazing student, he says, you know what? If this only has the potential to break, I'm going to make sure that there's no divergence, no loss of momentum on my entry chart. He has strong triggers, and his window of opportunity is 2 ticks wide. And guys, I'll come back to that, I promise. His window of opportunity is 2 ticks wide. That's it. He enters, his stop keeps him safe, and he gets paid all the way down to trouble. All the way back to that area that only has the potential to break, or actually the next fib. And what a beautiful trade, guys. And this is one of those trades where if I were trying to work that 50-50 trade into my plan, I would steal that one and I would go to the spreadsheet and I would drop that link in there. And when I labeled it, I would call it Morgan's Perfect 50-50. And now Morgan is immortalized in this spreadsheet that I give out every day. So what he's sold. So Hong, the trend is down. So he's going to sell. The momentum is down. He's going to sell. The path has the potential to break to the downside. So when the small chart's coming up, Morgan sells right at the area inside of triggers. And he chickened out a little bit. He should have been in at the fib, but you know, maybe he just opened up. So he sold the market while the small chart was on its way up. But look at the large chart. It never even blinks, and that's why we use the 2-chart process. The refinement chart reduces risk. It maximizes profit potential. And here's one of the cool things. Check this out. Morgan was 3 ticks away from the fib, 2 ticks away from the fib. But from his entry, he had almost $200 worth of profit potential. Isn't that cool? This is why we refine our entries on the small chart. And Morgan says gold is temperamental, so he adjusted his plan a little bit. Great trade, Morgan. Beautiful trade. So when the market's going down, we sell. When the market's going up, we buy. Buy is the same as long. Sell is the same as short. So let's talk about that mid-band behaving as a termination condition, guys. When you go to the trading guide, and it gives you that list. These are instructions, ladies and gentlemen. For you guys with spare parts laying around the grill, this is that piece of paper that fell out of the box. These are all of the areas that may stop the market. Fibonacci support, Fibonacci resistance, one-to-ones, all those horizontal lines on a large chart, right? Divergence highs, divergence lows, even 3 divergences in the same area. And then the last one on here, guys, is a large chart mid-band if the large chart triggers are a full bar away. And the reason this happens is because of this phenomenon called the gap theory. So guys, we're about to get a fresh lesson in here. The gap theory says that if price pulls away from the synthetic triggers, the large triggers, too fast and too far, and it hits an area, Fibonacci area, it will snap back to the triggers. Remember when I said price returns to the large triggers? So this helps you identify on the large chart when price is more likely to snap back. And what happens is price accelerates away from those large triggers. Notice that the price bars get way up here, but those large triggers stay way down here. This little bar right here is what we call a reversal bar marker. And this shows me the exact price where this bar behind the arrow will become a down bar. If my large triggers are below that reversal bar marker, then they are more than a full bar away. And guys, this is when the mid-band behaves as a termination condition. This is when you shouldn't take that long trade before the gap is closed. And what happens, where's the second picture, is price accelerates super fast and it hits that mid-band. It hits that termination condition. And the large triggers are hovering way up here. Very often, price closes that gap. It's like a vacuum sucking back. And really, any short trade that you take between here and there is likely to get run over as it closes that gap. Does that make sense, everybody? And if you go to your spreadsheet, under patterns that repeat themselves, let me scroll back up here. Guys, there are probably 25 pictures of the gap theory. Price comes down, reaches the areas, large triggers don't follow. Look how it closes the gap. So if you got excited and tried to take a short trade somewhere right here, you got absolutely run over. And it takes a little bit to learn how to recognize it. Sorry, Ollie. Price gets to that mid-band, even a little bit beyond, and the large triggers don't follow. Hong, Tom, everybody, do you see how there was room for a complete reversal bar before it hit those triggers? That look right there says don't take the long, which means don't jump in at that mid-band because it's likely to close the gap. Price came all the way up here, Hong. Look at how far away the large triggers are. There's an entire bar before price ever comes back and hits them. Does that make sense? So this gap is likely to get filled, which means that if you take a trade inside of that gap, it's more likely to get run over than not. And let's see if we can find some real-world examples of it real quick. And guys, this is the best part about this classroom, when we pause and we go back and we find lessons. So right now we've reached the mid-band. Those large triggers are just below the reversal bar marker. This isn't the gap theory. But right here, price reached resistance. Look how much space there was back to the large triggers. There's a perfect example. If you thought that you were going to go long with odds favorable momentum, it didn't work out. It closed the gap and actually finishes the move down to Fibonacci support. Once again, right into support, right into the mid-band. Triggers were a full bar away, and sure enough, it closes the gap all the way back to the triggers. This is a great way to study the gap theory, is just scroll back and see how often it happens. Almost the gap theory there, but it's still pulled back to the large triggers. Pretty much gap theory right there. So guys, most of your lessons are going to happen outside of trades. Most of your lessons are going to come back looking at these patterns. There's a really good example. Hong, do you see it? Price accelerates and hits that mid-band head first, and the large triggers just don't follow. And sure enough, it pulls back and closes that gap right to them. Just another pattern. Things that you'll begin to recognize. My large triggers are above. We'll see if it closes the gap back to those triggers. We'll come back to it in just a minute. Great lesson, though. And Ollie, sorry I had to use your chart for the lesson. But it's a pattern that repeats itself. That's all the market does, is it repeats itself. And the more time you spend in front of the market, the more you're going to recognize these patterns in the moment. Let me see where I'm at. And Joe presented a pattern in the market that you see very often. One line inside of triggers, two divergences don't scare them, and very often this pivot stop out here creates a little one right here, right at that line. That's good pattern recognition, Joel. And then Hong, when I told you once you get momentum in a clear path, you're likely to find a way to make money outside of it. outside of that pullback to an area. So in a strong trending market, everything is up. The path is clear. Ron gets above any trouble on a small chart and really just capitalizes, takes a quick little hit, makes $100 a contract, and life is good. Not at all a high probability trend trade, but very much embracing and understanding the idea that when there's nothing in the way and the market is screaming, it creates opportunity. Nicely done, Ron. Ron taught me this trade. I'm not just the Hair Club for Men president, guys. I'm also a member. I learn from you guys every day. Every day I get to learn from you guys, and I appreciate you all. All right, Wayne with the triple shot. Let's see what Wayne's doing today. Termination. Everything says up. You say perfect conditions for a white bar trade right off the bottom. And you didn't get it because it was moving so fast. And then, Wayne, you're absolutely right. Perfect recognition. And even though you didn't catch it, you took the time to go back and say that the large chart leads the way, that I have to have a termination, that I need these triggers to roll and I wait for the white bar. And this is an advanced trade. Wayne is 10 days into trading with Nexgen, guys, and he's already been able to use his chart rating to go outside of high probability and capitalize on this next trade. And it's freaking amazing. Once again, a great top. The white bar's a little further down, and that's okay. And it just lines up with this beautiful entry here, and down it goes. What a great trade once again, Wayne. There's that termination. Everything's down. Second trend trade with pullback to the mid-band. Stop 3 ticks above. And you entered at 88, right at the area inside of favorable large triggers. And it took you right down to the termination condition. Guys, this is 10 days in. 10 days in. Once you understand terminations, and once you understand momentum, the world is your oyster. How to post pictures. Veronica, are you comfortable taking pictures? Let's start with that. Let's do a picture taking lesson. If I click capture, do you guys have your capture software up? And let me ask that question first. If you took it with your phone, Veronica, you could try to just, can you just copy paste the picture into the chat box? I think that's going to be the easiest way to do it from a phone. Check it out, guys. Patterns repeat themselves every day. If you went short at the mid-band, you probably just got run over. So Hong, there it is live. The gap theory. This is a termination condition anyway, but if you thought you would take a chance, look what the market just did. Isn't that amazing? I used to think my brother was psychic when he said, hey, we're probably going back to the large triggers. And then I realized all I had to do was study a pattern. And it did exactly what the pattern suggested it would do. If the rules are met, I can, Hong. But what you're asking me to do is take a trade, and that's okay. But I have to do it with the rules met. So if the rules aren't met yet, they weren't here, then we're kind of at the mercy of the market to give us a trade. I can show you how I would do it if you can play hypothetical with me a little bit. If hypothetically I wanted to enter at this fib for a long trade, I would have to right click just above it and click on buy limit 2. And that's how I would activate my order if I had an area inside of favorable large triggers. And then once I'm in, I have to go through and I have to move my stops, and it's hard to talk through it. Hold on. Let's do this. There's always an answer, right? There's always an answer. Let me just scroll back and find one that looks like an entry. Bum, 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 bum. All right. And I'm not sure what this looked like on the large chart, so let me circle it. Whoops. That's not what I meant to do. Gap theory is the large chart, Wayne. We're identifying termination conditions on the large chart with the gap theory. I'm trying to find one that we can just go through start to finish, Hong. You're welcome. I know we had one yesterday. That's not it. Son of a gun. All right. Bum, 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 bum. We're going to use this one. All right. So first and foremost, the most important thing. Large chart leads the way. So in order to look for an entry, before we ever look for an entry, large chart has odds favorable momentum. Do you see it? Cool. And then you know what? I think this is the one we did yesterday, so we'll just do this one too. Large chart has odds favorable momentum. Large chart has a clear path. Are you comfortable with that? We're using the most current bar. Everybody good with this? This is your look. This is what it looks like when it's time to look for an entry. So on the small chart, it's going to look like this. It's going to be screaming to the upside. And it's going to keep going. And our job right now, Hong, is to wait for a reversal bar. The large chart said, let's look for an entry. So we wait for the reversal bar. At the time of the reversal bar, I'm going to look for those favorable large triggers. Large, synthetic, overlapping, one on top of the other. Are you with me so far? And guys, this is what we do every day. But the trigger lines aren't my entry. So I narrow my focus to whatever areas are inside of those trigger lines. And guys, I've got one box. One line, the mid band, right there. I'm going to right click and I'm going to put my entry a couple ticks above that mid band. And Hong, that's it. That's all you have to do. And at this point, you're at the mercy of the market. It either comes back and gets you. There's our entry. So because my entry is 2 ticks above, where shouldn't the market go? The market shouldn't go about 4 ticks below those triggers. This is your initial stop placement. And your ATM strategy may have your stop at 12 ticks. 12 ticks. Yeah, Veronica, that's okay. 12 ticks gives you time to react to put the market where the market shouldn't go. Does that make sense, everybody? And Veronica, you just had an aha moment. So I'm in a trade. The momentum is strong, the path is clear, the entry is just above support inside of triggers, and now I'm at the mercy of the market once again. I'm either going to get stopped out 4 ticks below the triggers, or it's going to go in the direction of my trade. And it may go against me a little bit. I know that price can pull back in those triggers. And then it gives me a reversal bar. And this reversal bar says, hey Mark, guess what? We're going up with momentum. We're going up with a clear path. We are coming off of the area inside of triggers. Go ahead and reduce your risk 2 ticks below it. The way the KISS plan is set up, your first target is $100. So from 56 to 66 is a $100 target. Your second target is $200, which means 76 is the $200 target. So the white lines are where we're trying to go, Hong. We're already in. It's moving in the direction. Our stop has been moved, and it's going. And it's going, and it hits our first target. This is what the KISS plan. You just made $100. Congratulations. You get to supersize at McDonald's today. And the KISS plan for brand new users says, hey, when you hit that first target, let's go break even. Let's get rid of all of our risk, and let's learn to trust the large chart. Let's learn to trust that that momentum is a winner, that that momentum pushes, and let's just see if we get to our second target. And the market goes up. Oh, and then it turns against me, and that's terrifying. Because what if I lose? You know what? The KISS plan says be willing to get stopped out, break even. You've already been paid. Don't move your stops. And the market comes closer, and my palms get so sweaty because I'm about to lose some simulated money. I'm sure I'm going to lose this trade. How could I not? Look at the red bars. Oh, and they're even closer. But did you guys notice that it came right back to the mid-band? And then sure enough, it's headed back up. And if I would have jumped out of my trade, no, it closed itself out, Hong. Once it hit the target, it pulled itself out of the position. I didn't even have to do it. I just had a target there. And when it hit it, it exited that contract and left me with one contract. And that contract started dancing, and it made me so stinking nervous. Jim, how many divergences does it take to ruin a high probability trend trade? We're on the KISS plan. Guys, stop complicating shit for the new kids. It takes 3. And we're following the KISS plan. I still have one open, Hong. I still have one open. Jen, we're just doing the KISS plan. 3 shall be the number. So we're going to hold that trade. The KISS plan says go break even and sit on your hands. And you're either going to hit the second target or you're not. And you just made $300. So, Hong, I'm in 2 contracts. When price reaches the first one, it will automatically exit 1. It'll pull it off, it'll pay me, it'll get it into my account. I don't have to worry about it. When it hits the target, it automatically happens, which means that I'm still in one of those 2 contracts. And right here, I exit the second contract. It'll take me out at my target. So this is automatic. Your targets are right there. Because I set the ATM. The only thing that I'm moving in the trade, Hong, is my stop. Initially, my stop is 4 to 5 ticks below the triggers, where the market shouldn't go. Once I get a reversal bar, my stop is 2 ticks below the reversal bar per the KISS plan. Once my first target is hit, my stop is break even. That's where the red line was. And it's either going to hit the break even or it's going to go to my target. And in this case, it went to the target. And that was $300 profit. So to move your stops and targets, let's go back to the live market. To move my stops and targets, so let's say I'm in a long position. My targets are off in the distance. If I click the line, I can put my target at $100. If I click the line, I can put my target at $200. This is not a high probability trend trade. Everything is red. So my initial stop is probably below And let's say that it goes and it hits my first target. All I have to do is click on my line and I can move it. That point, I'll move it to break even. When I click it a second time, now my stop is break even. So if it hits my first target, let's see if we can make it do it. If it hits my first target, it'll exit one contract. Come on. It's hard to fight all that stuff, but we'll see if it does. Surefire way to make it not hit is to try and do it live in class. There we go. It hit the first target, and now I have one contract left, and my second target's off here in the distance. Does that make sense? And my stop is at break even. Andy, have a good one. And then if it hits the second target, let's see if we can make it hit the second target. Yeah, this is the live market. Hit my second target, and I'm out. And that's it. I didn't have to do anything. It pulls me out. This is live Hong. This is not a trade. This is not a high probability trend trade. This fights momentum. This fights terminations. This fights the trend. This was nothing more than an example, ladies and gentlemen, of how to move stops and targets. So again, if I go short, targets are in place, stops are in place. If I need to move either, I click. If I put my stop right there and the market comes up and hits it, it'll take me out of both contracts. If for some reason it crashes down, maybe it hits my target. See how it stopped me out of the trade? It shows me exactly where I entered. It shows me exactly where it stops me out. Does that make sense, Hong? So this is the stuff that I want you to practice on Simulator. I want you to come at it and say, you know what? This isn't a trade, but I'm going to jump into that trade. And I'm going to learn how to move my targets to the first sign of trouble. Well, this time I hit buy market. So my targets are above me and my stop is below me. If I hit sell market, my targets are below me because I sold and my stop is above me. And once again, I don't have momentum or a clear path. So anything that I do right now is financial suicide. It's nothing more than a lesson on entering and moving stops and targets, because that's part of the mechanics that we need to learn. Does that work? And I know you guys want to see me take trades live, right? Everybody thinks that if they watch me trade live, that it's gonna be exactly what they need. So guys, if you need to see a moving market, if that's kind of your thing, go to the video section. There's actual playlists. There's the 60-second video series. These are videos that I put together. There are a lot of different trend trades and turning points, terminations, studying the trend trades. All of these are 60 seconds long, guys, and they just take a snippet of what I teach in the room and break it into a quick little in motion. So please go check these out. So like if you click on trend trade short, it's going to actually show me from entry to exit in a moving market. And I'm talking through it. I think I am. I might be. I don't remember. But it goes through stop placement, and you can actually watch it happen live, guys. So go look at these. Worked hard on those videos. Let's get back to business. Let's get back to looking at y'all's charts. And guys, great questions. Awesome, awesome stuff. Let me figure out where I am. All right, we made it through Wayne. And now we got Pete. And guys, remember, experienced traders. And then Pete says, Mark, yesterday you said you didn't know what the buy, bid, buy, ask buttons were in Chart Trader. Pete, I have an admission. I have to admit something to you real quick. I know exactly what they do, but I don't need them, and nobody in this room needs them. So it's easier for me to feign ignorance and say, guys, I have no idea. I never used that nonsense, rather than forcing people into trying to learn something that they just don't need to know. Sorry, I don't feel like I can lie to you. Trading in your TradeAvate account today, but here is your last trade. Triggers rolled up, odds favorable momentum, waited for the large to clear the fib, and then you get above the 1-to-1s and hold it all the way up. Beautiful trade, Pete. Getting in beyond trouble, understanding that it may pull back to trouble, trusting the system, trusting the stop placement, and letting the large chart lead the way all the way up to Moneysville. That's an awesome trade, Pete, and a great hold. And the longer you spend with the software, the more confidence you get in it, the more you are willing to hold that trade when the large chart is spewing with advantages. Nice stuff, man. Jeffrey Dean. Saw the scissors were wide with a few fibs in the path, but felt it was a good 50-50. And you just jump in, didn't wait for the areas, and you traded with no room into a fib, hoping that the areas break, right, Jeffrey? Just saying, man, I sure hope these big lines that stop the market more often than they don't choose not to do it today. And you got lucky. And the market gave you $320 worth of luck. And the market will always, guys, the market will always let you win the wrong trades when you're on simulator, because it loves to take that money from you as soon as you go live. That's why I encourage you guys, try to practice the right trades. It's okay to make mistakes, but try to practice the right trades. Not a termination, triggers are wide, background red, pull back to 89 to 53. So GWC, guys, GWC's been with me for a while. He says with this look of momentum, I'll try to catch a move down to trouble, but if absolutely nothing blinks at trouble, I'm going to extend my win a little bit. Nicely done, GWC. This is experience, ladies and gentlemen. And then you said change from blue to red. Good for short. GWC, can I respectfully disagree with you? Because the color of the fib just doesn't have anything to do with it. The software believes that it does. But I want you to see something. If I change that to hot pink and you can't see the fib at all, there's 3 very specific looks. And this is for new users. Morning, Cindy. When price reaches it and the triggers stay above it, it's a termination. When the small triggers break through but the large triggers don't, it has the potential to break. But it's not until the triggers get through that it's considered broken. And guys, if you focus on the color of the fib rather than the trigger location, it's going to whip your tail. Because this one changed colors and it never broke. This one changed colors before it ever broke, and look at the big snapback. Guys, it's trigger line location. Trust me on this one. I promise you I wouldn't steer you wrong. It is trigger location versus the area that determines whether or not an area is broken. And with the potential to break, you will see. It has the potential. So GWC, I know you're in a position, but I disagree wholeheartedly on that. Because that's already changed to blue. It's not even close to broken. Do you guys see that? That one changed to resistance. It never broke. That one changed to support. It didn't break. So there's calculations, guys. This is why I teach trigger line location every day. And now it has the potential to break. So great lesson there. GWC, thank you for posting that. And I know that you've got a solid plan. And that lesson probably doesn't affect it one bit. But for my brand new users, that's a very, very solid lesson, reminding you to let the trigger lines tell you whether or not the area is broken. So not a termination. It actually blew through everything. Triggers. You had a clear path to the upside, but without momentum, it turned. That was the potential to break that didn't. And now we have a rock solid termination condition. We have price reaches the area, triggers remain below. When it reverses the market, it's a strong top. But twice, it changed colors. I love it. And GWC says, check it out. With all that momentum and room to get to trouble, you better believe I'm going to capitalize on that look. And you do an awesome job of it. Awesome job of it. Once again, super wide triggers. Holy smokes. Guys, if you want to take a page out of GWC's, he's looking for momentum before he thinks about taking a trade. He's insisting on the best look. And then he's finding an opportunity with all that momentum. GWC, great trading this morning. Letting momentum lead the way. Making sure you have room to your targets. I told you guys, once you figure those two out, once you can say to yourself, I have momentum, my path is clear, you're going to find a way to make money. It's difficult not to. Back of price clears trouble. So Jen, the one challenge here is you never cleared trouble on the small chart. Not yet. So I know you're working on that chili dog trade. Get a clear path on both for your highest chance of success. And I'm working with John on it right now too. This is the hardest one because you hyper-focus on this chart and you get so excited about it breaking that you forget to look right sometimes. Large chart's perfect. These lines create bounces though. They really do. And then weak triggers makes it even worse. So I'm glad that you got a little bit out of there. Nicely done, Jen. It's funny, for a trade that appears to be so simple, it takes some study to get good at it. It really does. I know because I've been studying it for the past 30 days or so. And then Morgan, odds favorable, clear path, nothing in the way, strong top. Guys, this is the sexiest look for a high probability trend trade that you'll ever take. No areas inside of the triggers here. Two lines, one on top of the other. Morgan gets in, correct stop, quick profits. And Morgan, can I tell you how proud I am of you that you're holding this trade? Can I tell you how impressed I am with you right now? That you are still in this move on the way down. You're protecting yourself. But you didn't just jump out, right? You let the large chart lead the way. Absolutely amazing, brother. What a great job. Confidence comes through repetition, guys. I can't give you repetition. You got to keep doing it. But you'll get there. You will get there. Andy Man. Same trade. Gets in at the lower area. Stop keeps you safe. Out at the first sign of trouble, and then right down. And this small chart scared the hell out of you, didn't it? This is a good lesson. Guys, fluctuations on the small chart will do their absolute best to terrify you. Remember that the large chart is why you're in this trade. The large chart is the reason that you went short. Don't let 2 or 3 ticks make you panic and jump out. Great job. Great job, Andy. Love your entry. You waited for the area. He's not here, but if he watches the video, I want him to hear the praise. One of my favorite things is when you guys take a lesson and then learn that lesson. And Ollie, we looked at yours and talked about it, so I'm going to go with Wayne here. Everything says up. There's nothing in the way. It didn't quite give the entry, so you catch it on the way up. Little base hit, right at trouble. No, I think you're fine. You're catching it on the way up. This divergence could have created another bounce, but if you're ready for it, no worries. Nice job, Wayne. Andaman, same trade. Oh, here's the question. I think I know better. Is the divergence a better signal to get out and exit? All right, guys, little management lesson here. This divergence line wasn't there. This divergence line is from the next bar's pivot and wasn't true until all the way up here. There's nothing in the way. There is absolutely nothing in the way. There is no reason to exit this trade other than you just want to get paid. This divergence didn't happen till long after that market started back up. But if there were a divergence line, absolutely, what a great place to get paid. Because that's an area that may stop the market. And that's the whole idea. When you can see it, what a great target. Good stuff. Let's see what Ron's doing. Ron says that the back of the bar clears the fib, letting him know that price has cleared it. Everything says up. So he gets in when he clears this one and grabs some money. Beautiful trade. So Jen and you guys that are trying to replicate what Ron is doing, do you see how he let it get above that divergence high? He said to himself, I don't want to give it anything to bounce off of. I want to get to the other side of bouncy things and head that direction. It's a good lesson. Strong bottom, odds favorable momentum, no clear path. Whose chart am I looking at here? Cheetah? Cheetah, do you recognize that you're trading directly into a fib? That's my only question. Because sometimes, guys, you may choose to trade into a fib. But that great entry sure gave you room to get back to trouble. Right? Not a high probability trend trade, definitely not a clear path. But with momentum and a perfect entry, why not go back and retest the area? That might be the next trade for some of you guys. It's probably going to lose more than it wins. Trigger separated, odds favorable momentum, waited for it to clear trouble, gets in, and rides that wave of momentum all the way up. And I don't know what pivot stop out you're talking about, but great trade. Nice one, Pete. No. Cheetah, what I mean is that this is a termination, right? 100% trading into an area that may stop the market. Everything says up. The momentum is strong. And you bought, right? You entered the market to go up, obviously. Wouldn't it make sense to get paid at that giant wall of Fibonacci instead of just hoping that the market breaks it? Because how often do these areas stop the market? You already cheated death once by getting back up there. And dude, that's $200 into trouble. So this is one of those things, you know it's trouble. If you choose to take the trade, your entry is beautiful. The risk is virtually nothing. And this represents a point where everything could go wrong for you, Cheetah. And I notice that you don't have stops or targets on your chart. Or you've got them hidden somehow. Or they're so far off the charts that they don't make sense. Stops and targets are designed to protect you. And every guru in the trading world, every person that teaches people how to trade will tell you that if you trade without stops, you're a fool. Cheetah, I'm not calling you a fool. I'm just repeating the words of the people that are smarter than me. If you don't protect yourself, guys, we're too good at what we do to not protect yourself. And then Wayne, so Let's do this. You're going to like this one, Wayne. Here comes a good lesson for you and for everybody. And Mr. Duval, I hope you're not just frustrated, confused. And I promise you tomorrow's better and every day after. And I just want to reach out to you guys that are new and you're like, this isn't a trend trade at all. What the hell is he doing? Guys, this is what happens when you start to learn to read your indicators. You find more opportunities. So check this out. Are you with me, Wayne? Got a great lesson for you here. And this is for everybody. It's not just Wayne. I'm going to use an arrow and I'm going to thin it out a little bit. So here's your first divergence, right? I'm going to extend it off into oblivion. Once the small and the large triggers get above it, Wayne, the same way it is with fibs 1-to-1s, this divergence is no longer in play. And this becomes your first divergence. And once the small and the large get above this divergence is out of play. The same way, once the small and large get above this divergence is out of play. So to be honest with you, you got one divergence, brother, which isn't nearly as scary as 4. Does that make sense, everybody? We're going to use that same idea that we use for breaking areas for when we decide that these divergences are no longer problematic. So this is actually one divergence up here because these have been cleared by the small and large. Can you guys give me a why if that makes sense? And this is why annotation is such an important part of what we do. Because I wouldn't have known to give that lesson if Wayne didn't give me the opportunity. So thank you for that, Wayne. Let me see where we're at. Dun, 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 dun. You guys learning anything yet? I hope so. I sure hope so. Ron says, from a termination, price clears and he's on the fast side of the triggers. And he clears trouble here and base hits by chili dogs. And guys, that's why you're going to hear me call this trade the chili dog. Because Ron has an affection for chili dogs and it cracks me up. So we named the trade the chili dog. Pretty cool. Arrgh. Every day, Cindy. All right, so weak top. Are you talking about up here, Cheetah? This is very much a weak top. Jumping in trade, Rob. That's all it is. Very much a weak top. Well, pointed there, so that's okay. So that's only one part of it though, right? Is the momentum. Cheetah, what do you see here at 66.36? What do you see right here at 66 flat? Do you see all of those Fibonacci areas and not one trigger lines through it? So you have a termination condition, right? Do you see it? I just want to make sure. Okay. So you really shouldn't be asking where the area for entry is. Because there's no areas inside of these triggers, but they're way up here. It's directly into trouble. And if you try to create entries directly into trouble, you're probably going to lose more than you win. So I don't have an entry on the small chart because I don't have rules met on the large chart. Cool. Great picture, man. And I think we all need that reminder every now and then. Let the large chart be perfect, and even mistakes on the small chart get covered up a lot of the times by it. But I always go through that two-part process every trade. Do I have momentum? Is there a clear path? And if I can't answer yes to both of those, it's not my trade. Odds favorable, not odds favorable, but all triggers up, Wayne. So guys, people love to throw around the odds favorable. My triggers are up. It must be odds favorable. Both are green. It must be odds favorable. But the reality of it is odds favorable momentum is only one look, guys. Odds favorable momentum can only be one thing. And let me get to a picture just so that there's no misconceptions about it. This is odds favorable momentum, separation between the small and the large. This is a slowing of the trend. Nope. When one line goes in, it's beginning to weaken. When the smalls are inside, it's weak. Anything can happen up or down. So scissors open, cheetah, yep. I can cut. I've got momentum. You can visually see the momentum is slowing, and now it's weak. So guys, let me give you this picture. That's kind of the life cycle of momentum right there. So what happens, and I'm going to turn this into a whole nother lesson, you guys are going to dig this, is we've got those weakened triggers, right? But a clear path, without question, a clear path. And he's got Fibonacci that's likely to hold. It's a couple ticks outside of the triggers. So this is one of my favorite learning tools. That's pretty cool. And guys, you can make one of these for your desktop. Is take the 3 advantages, right? And really the 2 advantages. Print it out, put it on your desktop, and cut 3 sheets of paper. 2, 3 sheets of paper. So when I look at Wayne's picture, I have to say, you know what? I don't have momentum, and I cover that advantage. And this is literally 33% of what I'm looking for. And then I have to say to myself, I absolutely have a clear path. I won't cover that one up. And then I have to determine, do I have an area inside of favorable large triggers? If the answer is no, and I cover that up, that's another 33% of my advantage is gone. This is how you learn to take medium probability trades. If you only have one advantage left, guys, you have to say out loud, do I want to risk my money on 66% of my advantages missing? Is a clear path enough? And only you can answer that question. Only you can answer that question. But as a brand new user, this is going to keep you out of a lot of trouble. So Wayne may say, I've got that clear path and everything is up, and my area is not inside. So I'm not sold on this entry because once I'm on the wrong side of the triggers, I don't know, they might try to get that mid band with the weak triggers. Hell, I don't know. I never know. So Wayne, in this instance, you could say everything is up. This area might hold. Let me force a little confirmation. Let me force it to go in the direction of the trade. And at least then my risk is established and maybe I can ride that uptrend. Does that make sense? And all this is a little modification, but you're speaking to yourself in terms of advantages. So you know what you're getting into, and understanding what you're up against makes it easier to take a trade. Cheetah's trade earlier is an outstanding example. Where did that one go? Because it was beautiful. It had momentum, but it didn't have a clear path, but it did have the area. And what Cheetah was able to do here is Cheetah said, you know what? I've got momentum, but I don't have a clear path. Let me insist on these two and take this awesome trade. No, I don't try to predict lows, Wayne. I don't try to predict highs. I use my trigger lines because I could say, and let me show you an example. I could have said, if a short right here didn't work, well then maybe this fib is where it's going to stop. Or maybe this divergence high. And what you'll do, and maybe you won't do it, but I've done it, is with this look, rather than following rules and trying to predict, I go short right here. Let me change colors on these so you can see them. I may try to go short right here. And I say, well, if that's not the low point, it has to be the fib. And then I try to go short at the fib. And then my brain says, Mark, you're right. You're always right. People know you. Go short at the divergence high. That's got to be that possible area. And then I get run over again. Well, then it's got to be the fib. Well, if it's not that fib, surely I should go short at this fib. Okay, the one-to-ones, but this is the last one. And this is how people lose millions of dollars. John Novak had a client back when the S&P tanked, and he did this exact thing the other direction in a falling S&P. And he lost $12 million that day. $12 million. So, Pete, on your picture, I don't have any idea where it could potentially be. It could be here, it could be here, it could be here. It could drop for the next 3 days. Once my areas are outside of those trigger lines, it's nothing but a guess, which is why a confirmation bar at least gives me a ray of hope. It gives me something to put the stop behind. Does that make sense, everybody? I've given up momentum and I've given up an entry area. Let me force a little confirmation there. There's a cost associated with it, but it's typically less than losing $200 or $300 as it blows right through you. And remember, guys, what's the goal? The goal is to get paid more often than not. So great picture. You would have had to get a little fancy with it. Pete, 50-50, odds favorable, everything says down. Perfect pullback right to the mid-band. Going to enter here, but I know how Mark hates it when I trade into termination conditions. Where's your termination condition, Pete? And don't worry about what I hate. I hate apple pie. It's a 50-50, brother. Your smalls have absolutely smashed. You have the potential to break because of the momentum, and you're trading on a pullback right to it. Hell no, that's a perfect trade. That's a 50-50 trend trade. Now, if you had gone short right here directly into the blue line, yeah, we would talk. Dude, you're almost all the way through it. You're just taking the perfect trend trade. And it worked. Does that make sense? There's a difference between jumping into trouble and letting trouble be your reason for entry. It's a beautiful trade, Pete. Beautiful trade. High fives. Clara, how you been? Clara shows up once a month just to remind me that she still knows what she's doing. This one had the split triggers. You chose to avoid it. I love it. This one had the favorable triggers. They're real close. And it was so easy to pick out your entry. And you knew right where your stop had to be. You chickened out. So, Clara, remember, it takes 3 to kill this look. It takes 2 to make a thing go right. And it takes 2 to make it out of sight. Yeah, and that happens sometimes. That's where repetition comes in. So this was pretty much the market saying, let's get Clara for a short trade. And then right here, the market said, oh my gosh, did we forget Clara? Let's go back to resistance inside of triggers and make sure that she catches this all the way to the fib. They even gave you a second chance. They love you. But this is why repetition is so key, right? This is why repetition is so key. Because if you do this 100 times, you're not going to make that mistake again. If you post it in the room and we talk about it, you're less likely to make that mistake again. And I'm just thankful for the opportunity to say hello. All right, Miss Veronica, here we go. So, this is the same trade. And Veronica, I think this is where you said, oh, the triggers isn't the entry, right? And oh my gosh, bravo. Look at that large chart. Look, Perfect. Veronica, absolutely perfect. Large chart look. And I'm tempted to say that you and Claire may be in cahoots. There may be some shenanigans going on. And then you just got a little bit excited and you got in. And I love it because your brain was in the right spot. And then it comes down. And do you recognize this as your perfect entry now? Right there at the areas inside of the triggers. Beautiful. Veronica, day 2 or 3? Day 2 or 3. And you've already got the large chart figured out. And now we'll take a week to make sure that you get those entries in. Outstanding. And this is where I have one of those proud papa moments, because I firmly believe if you allow it to be simple, if you focus on some very basic ideas, you will find success with the software sooner than later. And you will know before your demo's up that absolutely this stuff works. And you're almost there on day 3. Ron says, I believe in termination conditions. I also believe in the gap theory. And guys, this isn't a trade that I teach. But Ron says when price accelerates away from the large triggers and the large triggers remain a full bar away, price is likely to close the gap. So Ron says, let me see if I can't close that gap. Not a high probability trend trade. But once you learn that gap theory, we talked about it earlier. The gap theory says don't go long right here for brand new users. Absolutely. Let me blow his up a little bit. But once you have some experience, the gap theory might be an opportunity for you. So, Miss Veronica, price accelerates off that support and it screams right into Fibonacci resistance, right into a mid-band. That's the first part. See this white bar right here? So this white bar is what we call a reversal bar marker. And you have one on the large chart and you have one on the small chart. But on the large chart, this is a large chart phenomenon. If the large triggers remain below that reversal bar marker, price is likely to close the gap back to them. This is a pattern that repeats itself all the time. So as long as these large triggers are below that reversal bar marker, price is likely to come back and close that gap. So on a live chart, this, and on mine it's gold, on Ron's it's white. This bar shows the exact price where this bar would have to get to in order to create a reversal bar. On the small chart, the gold one shows the exact price where this bar where price would have to return to form a red down bar. So we use this on the gap theory times like this. When price accelerates and hits an area, see how far the large triggers are? Your reversal bar marker would have been right here at the fib telling you, don't take the short trade. Don't trade into that resistance. Don't believe that this mid-band is gonna produce a winner because it's likely to close the gap. Does that make sense? So watch, boom, it hit it, and your reversal bar markers switch sides. Now this is the price where if price goes up, it'll create an up bar. Kind of neat, right? It's fun when everything starts to come together. And I gotta tell you, you guys are absolutely amazing for keeping the questions coming. You guys are absolutely amazing. You don't? Veronica, I saw that you took a picture on your phone with your phone, right? But you are sitting at the computer? Do me a favor, and Cindy, then we'll look at yours. Go to your search bar and type in tech. And you should see TechSmith Capture come up. This is one of the things that's downloaded on your computer when you get the software, because this is the easiest way for us to have a conversation. If for some reason you don't see it, do me a favor this afternoon and download it on your computer, because what happens is if you use this TechSmith capture, you can just click and drag and take a picture of both of your charts. And then you can even use arrows and boxes. These are all click and drag and boxes like that. And this call out box, this is the easiest way to talk. So if you're like, oh, Mark, I don't have that reversal bar marker on my chart, I can say something like, Veronica, do me a favor, just take a picture and drop that in the room for me real quick. And let me just make sure that maybe you're not, accidentally pushed out of screen or something like that. And then what we'll do is we'll say, let's do this real quick. Let's go to indicators, right click on your chart, go to indicators, and let's go to that T3 Fibs Pro Trader and nope, let's go to the trade synthetic and reversal bar marker 1 and make sure that it says show reversals. And if this is checked and you still don't have it, then what I like to do is have you click on the chart and hit F5, because F5 will reload your Ninja script, and a lot of times that'll put things back in place. No worries. So do me a favor, right click and go to indicators, and then from indicators, what we're going to look for, let me take a picture for you too so that you have it, so that you got it. So you're going to right click on the chart and you're going to go to indicators and you're going to go to T3 Fibs Pro Trader Send New, and you're going to make sure that that reversal bar marker is checked. And Veronica, I'm the most not techie guy in the world, but what you'll find is that with a little bit of repetition, you'll become a genius with this stuff. It just takes a little bit of practice. And then if it still doesn't load, so if that's checked, but it's not there, right click on chart and hit F5. This reloads, I'll just put stuff because it doesn't matter what it reloads. That's just kind of the way to do it. So let me put that picture in there. And typically that fixes it. And then, of course, if that doesn't fix it, Jason is the man. Let him fix it for you. But those are some of the easy fixes that come through. That's kind of, I like to go through that first wave and let me see if it fixes it. And then Wayne, this is like your chart earlier, right? Everything is up and the path is clear, but there's no areas inside of triggers. So instead of just arbitrarily jumping in at support, maybe waiting for confirmation. And I have a feeling this is about to show us why. That's a pretty good thing. Try F5. Right click on your chart, Veronica, and click F5. And see if that puts it on there. All right, Miss Cindy, sorry about that. Cindy says, all right, Mark, check it out. Not a termination, Miss Cindy, because it's not coming from anywhere. This is literally a pivot in the middle of nowhere. Does that make sense? There's no fib. There's no one-to-ones. And this divergence line didn't print till all the way up here. So yeah, not a termination. You definitely have strong triggers. What do you notice about it though? When we talk about this look right here, it is a termination condition, right? With that odds favorable momentum. I just want to make sure that you see it. You're trading directly into a fib, 100%. But you do have the advantage of strength. An easier trade, Cindy, and one that's less likely to create that bounce that we don't want, is why not just get in on the other side of trouble? It'll cost you a couple ticks, but at least you've cleared the problems instead of trading directly into the problems. Does that make sense? And I know that you're using that down-up bar over here to take it. And it's a great look all the way through. But why didn't you use that down-up bar? Why was it this one? In this one, you need to reload your indicators. Your stuff looks wonky. It's a beautiful trade, Cindy. I just like to, because we're a teaching room, I want to make sure that I remind people that trading into termination conditions is less likely to win. Trading, from the areas, it produces a real easy winner for you. Nicely done, though, and great recognition on the up-down pattern here. But you still have to have that large chart rules met to find the long-term success typically. And I know that when you learn stuff from my brother, everything looks the same for a little bit. But it's not. I'm talking about triggers as you're watching this setup, Rob. I like it. You've got momentum. You're coming from a termination. There is a divergence high, but we didn't quite reach it. And there's one area inside of favorable large triggers. That's a pretty good look. How'd it turn out? Did you take a trade? Two divergences, odds favorable momentum. It missed you on your entry, didn't it, Jen? No, if price reaches the reversal bar marker, it doesn't mean close the trade. Veronica, the only thing that I use that reversal bar marker for is to identify the gap theory. That's it. Is to identify when the triggers are a full bar away. Has nothing to do with anything. Don't let one bar scare you out. Because look how this chart never gets a down bar with all that momentum. This chart had 5 of them, or 4 of them, right? There was a reversal bar and then 3 down bars. Right to support, right at the triggers. And off it goes. And Jen, you were just late on your entry. Probably used confirmation and then got out of trouble. Does that make sense, Veronica? The only thing we're using this for is that gap theory. Okay. You gonna go raise the skull and crossbones on the golf cart? I love it. Terrorize the putt-putt course. Yeah, I might have to go play golf today. I haven't played in a couple weeks. I'm due. Great questions, Veronica. Thank you for that. Jen, a little late on the entry, but having a complete understanding of momentum and path, you still got paid. Nice work. And then Wayne, look at this. Odds favorable, potential to break, perfect entry, beautiful stop, easy freaking money. Does everybody see it? Momentum? Didn't quite reach. Rob, that's the one you said was setting up. How did you do? Did you catch that entry? Did you put your stop in the right place? Did you get paid at resistance? Wayne, no. Now you have to ask yourself, why not? Wayne, welcome to Nexgen. You're going in the Hall of Fame. So Rob, now you just have to ask yourself, How did I talk myself out of this trade? Because that's the other part of it, guys. And I'm going to tell you, Rob, I talked myself out of a million trades. And it used to piss my brother off, something fierce. I would talk myself out of so many trades for one reason or the other. And it all stemmed to one thing. And guys, I'm just going to air all my dirty laundry. You will talk yourself out of trades. You will talk yourself out of trades if you don't know the rules, if you're not clear on the rules, if you have a misunderstanding of the rules. This is a 50-50 trade. The smalls are above the large. The momentum is great. It has the potential to break. It hasn't reached the next area yet. So no divergence. Pull back to the area inside. Stops in the right place. Perfect. And look at that sniper entry. Wayne waited for the market to get to him instead of chasing the market. I freaking love this trade. What a great job. So if you missed it, you got to ask yourself why. And if you were waiting for high probability, Rob, if you said, you know what, I'm not going to take those 50-50s, we'll come back to you, Pete. Hold on. All right, Hong, great question. Bum, 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 bum. Let me take a picture of his picture. So let's go through termination conditions real quick. When price reached support over here, all the triggers are below. Can you guys give me a why if you see that is a no trades into resistance, right? Resistance may hold, it may stop, it may break. Hell, I don't know. Once the small triggers get above the fib, but the large triggers haven't cleared it yet. What I'm looking at is 50% of my triggers have cleared it, 50% have not. So I am 50-50 on this fib. Does that make sense, Hong? 50% haven't gotten above it yet, but 50% have. This is that 50-50 look. And what that means, we'll go back to this one, is I don't have a clear path. While I have momentum, the path isn't clear. So I'm going to insist on momentum and I'm going to insist on the entry area. And the other part that you have to pay attention to is price didn't reach that pink line. And it's close, Hong, it really is. But price did not reach that area. That's where language becomes so important. This pink area can become a target. And because Wayne buys the pullback to the area, he's got plenty of room to get to that trouble. So it's 50-50 because the smalls are above and the large isn't. And if I have to cross out one advantage, it's not a clear path, it's only the potential, then I will never call it a high probability trend trade. But he had the momentum and he had the entry area. So he took what's called a medium probability trade. Does that make sense? Does that clear it up a little bit? Awesome. Great question. Do not stop with the questions ever. Realized you could mimic your trades in TradeAvate on Sim, on NT. Triggers rolled. Odds favorable. Let me see where this one is. 807. 807. So long trade into a termination condition doesn't work. Does everybody see it? The first trade is directly into a termination condition and it just gets run over. It didn't fake you out, Pete. It told you don't go long. You told it to go to hell. And then termination rolls odds favorable. Perfect entry. 100%. And Pete carries that thing up and gets it all back. And you're thinking for the second exit was 3 divergences, but forgot that the first divergence canceled when the small and large got above. Yep. And it just pulled right back to support inside of favorable large triggers. Great trading, Pete. And guys, this is avoidable losses. This is experience taking it all back. And you know what's funny? It's the same price. It's the exact same price. They just had to work some stuff out. Great trade, Pete. Nicely done, man. Oh my goodness gracious. Yeah, Pete. And guys, if you don't think you'll make mistakes more than once, you're mistaken. That's your first one. Trading in determination conditions is the absolute, positively most broken rule because your brain will say to you, Hong, but what if it breaks? Imagine how much money you'll make. Veronica, if that termination condition just decides to break this time, you're going to Vegas. And the reality is, guys, rule number 2 is in there because 60% of the time it works every time. It worked here, it worked here, and it worked here. And it's ego and pride that makes us believe that it's going to break for us the next time. Trust me on this one. I am chock full of both. So Wayne, remember when we said when you don't have areas inside, you're just not sure where it's going to stop? And we're kind of seeing it. We're watching that dance without the momentum. And it becomes very difficult. I love areas inside of triggers. All right, guys, chart read. Is the market going up or down? We're going to do this from the very start. Is the market going up or down? It's going down. Do I have odds favorable momentum? This is where I want to see my Mr. Duwalls and Hong and Veronica. Wayne says yes. What do you guys think? Do I have strong triggers? Are the smalls below the large? Are the scissors open? Are they wide? Are they angled? Absolutely. We're going down, and yes, we're going down with anger. Do I have a clear path? Wayne says no. Hong says no. Veronica, what do you think? Every time I say that, people think the first 2 answers are wrong. Price reached Fibonacci support. All of my triggers are above. I don't have a clear path. Absolutely beautiful. So let's pretend, just for grins, that I did have a clear path. And I got the reversal bar. I want you to see something. And I'm just going to make this big so you don't get distracted on the other one. But hypothetically, if I had a clear path and the market pushes down and I get a reversal bar, I want you to see this. My rules say that price may return somewhere from the lowest point of the triggers to the highest point of the triggers. My rules also say that I know before I ever enter the trade that my stop goes all the way up here. Wayne says too much risk. Hong, do you see how much risk you would have on this trade? Even if you got in at the mid-band, that's huge. But the only lines inside of triggers are these 1-to-1s all the way up here. So if I put a limit order and I say, you know what, I'll go in up here, I like the risk. Ooh, mid-band would have gotten run over, right? Oh, but there's a reversal bar. Oh no, maybe I should get in at the mid-band. Damn it. And now we're all the way up here. You ask me, or you Google it. Either way. Every tick on the S&P. So let's do this. Let me make it so that I'm in between a point. So on the S&P, from 73 to 74. This is 1 point. Uh-oh. My font went the wrong color. Let's try this again. No. Here we go. This is 1 point. From 73 to 74 is 1 point. The way the S&P is built is inside of every point, there are 4 ticks. So 4 ticks to a point. 1 point, I'm just giving you this picture so you have a cheat sheet, is $50. Oh, no problem, Veronica. So 4 ticks to a point, math tells me that each tick is $12.50. And this is for the ES. So that'll help you just if you're trying to do some math and figure things out. Did he get you all squared away, Veronica? Awesome. I knew he would. Jason's amazing. I think I've known Jason for over 20 years now. So on crude oil, let's do the same thing. And crude oil is a little different. So every point on crude oil it kind of works in tenths. So from 71.40, from 71.30 to 71.40, this is 1 point. And 1 point is worth $100. And on crude oil, there's 10 ticks per point. So each tick is $10. So what a tick is it's the minimum amount of movement that the market moves. Crude oil moves in $10 ticks. S&P moves in $12.50 per tick. And S&P is 4 ticks per point. And crude oil is 10 ticks per point. And then when you get to the NASDAQ, it's $5 a tick and 20. So they're all individual. And you can always Google tick value futures. And it'll help you a little bit on there. Just so that you have it. And that'll get you where you need to be. All right, guys. I just looked at the clock. I love it. Good lessons. Let's do market replay. So let me close my workspaces real quick. You guys ready for market replay? And remember that all of this that I'm about to do is in a video for you. So if you don't catch it first time, it's okay. Go back and watch the video. And you'll be good. Is everybody ready? Everybody that need a market replay. Wayne, are you good? You ready? First thing you have to do is you have to disconnect from live. Gone. Black circle, I'm not collected. Or I'm not connected, excuse me. And I'm going to go to connections and I'm going to go to playback. And it's going to bring up the data. And down here at the bottom left, I need to get market replay data. I need to know what it is I'm going to trade. So I'm going to do yesterday. And I'll do it on crude oil. So I've got the crude oil 1124 contract. And I'm just going to put in yesterday's date, 9/18. And I'm going to download. And it's going to load it. And then once it's done, I'm going to hit continue. So when you download it, it may take a second, it may take 10 minutes. I got a super fast computer. So mine goes really fast. And then I hit continue, and it gives me the little Sony Walkman here. And one of the things you want to do is make sure that the dates line up. Make sure that you're on the 18th on both. And that way it'll be a little more streamlined for you. And then once you have it, guys, I don't want to trade at midnight. I like to push it forward to about 5. Because this is when I really start trading, or 2 a.m. for crude oil too. But once I have this in, I'm just going to go to my workspaces and I'm going to open my crude oil workspace. And it's going to load up for me on that day that I choose to play back. Oh, I lost Hong and she wanted this one. Whoops. So here I am. I've got my, it says playback account. I've got my ATM strategy. Everything is normal, just looks like a normal market, right? And if I hit play, it's going to move like a normal market. If I don't have a trade set up, I can bump it up 15 times speed. I can bump it up to 1,000 times speed and make that thing crank. But the reality is, guys, if you play it too fast, you're going to miss trades. So I usually never go more than 10. And what happens is I hit play, right? And I'm coming off support, whatever. Maybe I want to go long. It lets me trade exactly like I was trading. This isn't a real trade. But I can work on maybe a management strategy. Maybe I can work on an entry strategy. Maybe I can work on moving my stops, adjusting my targets. And I can do all of this. And I can go back and I can practice trades and I can follow my rules. And the way I think new users should be using this is if you think you have a high probability trend trade, hit pause, stop that thing, and open up your KISS plan real quick and see if it fits the rules. And then you're good. So that's a way for you to get even more repetition, to go back and practice even more, and you can do that every day. So to do that belt, first of all, you have to have it. And I think I have a copy of it. Hold on. All right, download that real quick, belt. And then once you download that, cool, you're going to have to go to your NinjaTrader control panel. And you're going to have to go new. No, I'm sorry, tools, import, NinjaScript add-on. And then from there, tools, import, NinjaScript add-on. It's going to bring up, just like you're looking for a file. Mine's in my classroom. And you're gonna click on it and you're gonna open it. And then it's gonna tell you successful NinjaScript download. Once you do that, you're going to right click on your chart and go to indicators, and you're going to take this one right here, Gemify, order line decorator, and you're going to make sure that it goes down to the list. You're going to click apply, you're going to click OK, and it's still not going to work yet, belt. So after you do that, you have to right click and hit F5, and that's going to rewrite your NinjaScript. And then that's going to give you that tool. Ta-da!